Hi, welcome to everyone in our audience. My name is Erik Gerding. I'm a professor of law at the University of Colorado Law School. I'd like to welcome you to our Regulating the Megabanks conference in honor of Arthur Wilmarth. I would now like to introduce Ming Newcomb, who is the editor-in-chief of the Colorado Law Review, who will make a few introductory remarks. I'll make a few remarks and then we'll turn it over to our first panel. Ming?
Hi, everyone. Doesn't seem like the video is working, but that's okay. Hi, everyone. My name is Ming Newcomb, and I'm the editor-in-chief of the University of Colorado Law Review. Thank you all for joining us today to honor Professor Arthur Wilmarth and to celebrate the release of his recent book, Taming the Megabanks. I'd also like to take a moment to thank Professor Gerding, who has worked tirelessly to bring this amazing group of speakers together, and the rest of the Colorado staff who have made this conference possible during a global pandemic, no less. To commemorate this event, the University of Colorado Law Review plans to dedicate issue 4 of its 93rd volume to the Regulating Megabanks Symposium. I speak for everyone on the journal when I say that we are absolutely thrilled to participate in this conference and to engage with esteemed academics and thought leaders on these important and timely issues. Founded in 1929 as the first quarterly law journal in the Rocky Mountain region, the University of Colorado Law Review has published path-breaking scholarship for nearly a century. Through the years, much of that scholarship has focused on constitutional and environmental law, as well as legal issues that affect the American West in particular, such as water law and public lands. As we enter our 93rd volume, we remain committed to in-depth exploration of diverse legal issues and to engaging policymakers, practitioners, and scholars around the country and around the world. It is true that the topics that will be discussed today affect Colorado, but that is because the issues have a national and global impact. Many of our participants will tune in from the Eastern time zone, as is fitting given where financial markets and federal regulators are located. And a few are even joining us from Hamburg and London. We are committed to having the Colorado Law Review be a forum for these perspectives and to demonstrating that Colorado law is a great place to study financial regulation and business law in addition to public law. This symposium on megabanks, honoring Professor Wilmarth, provides an example of this commitment, and we are honored to be a part of it. Thank you all again for being here, and I hope you enjoy the programming. And now back to Professor Gerding. Professor Gerding, you're still muted.
You think I'd learn how to use the unmute button after a year on Zoom. Thank you, Ming. Thank you to all of the Colorado Law Review staff and editors for making this conference possible. Thank you also to Yesenia Delgado here at the University of Colorado, who's helping us with logistics. Let me say a few words just at the beginning of the conference about our honoree. Arthur Wilmarth, who many of you know, has been a professor of law at George Washington University School of Law for over 30 years. He recently retired, and we wanted to take a moment to honor him and honor his new book, Taming the Megabanks, from Oxford University Press. Arthur has been a force of nature in the banking law world for over 3 decades. And his book is a real magnum opus and a capstone to a very long and distinguished career. It's a testament to art how easy it was to get all of our high-powered and insightful speakers, how easily it was to get them to sign on to today's conference. But it's not just the power of Art's ideas or the power of his scholarship that I want to talk about. Part of it is what I want to make sure that we mention throughout the conference today is Art's generosity, his intellectual generosity, his mentorship of other professors, his work in the policy community. And I'd like to make a special note of his courage. because Art's voice and his criticisms of financial conglomerates started years ago, and it was a pretty lonely voice. And Art took a lot of career risks early in his career to criticize the dismantling of the Glass-Steagall wall between securities and banking, and to criticize financial conglomerates. So the ideas that he presents in his book and that we'll be discussing throughout the conference might seem fairly mainstream now, or at least part of a mainstream debate. But it was a lonely time and a lonely voice at the beginning of Art's career. And he took a lot of career risks and took a lot of criticism as a young scholar. So Art is an example of how to use tenure and what tenure is for. So let me now turn it over to our first panel. We are going to have a fireside chat featuring Mark van der Weide, who is the General Counsel of the Federal Reserve Board of Governors. He's had a long career at the Federal Reserve. Before becoming General Counsel in 2017, he worked in the Division of Supervision and Banking at the Federal Reserve. Mark will be interviewed by Jeremy Kress, who is Assistant Professor of Business Law at the University of Michigan Ross School of Business. Jeremy is the co-director of Michigan's Center for Finance, Law, and Policy. And before becoming an academic, he worked at the Federal Reserve as an attorney in the banking policy unit. So let me now turn it over to Mark and Jeremy. Thank you both.
And thank you, Erik, and thank you for the opportunity to be here to moderate today's first session with Mark van der Weide. Mark, many of us involved in today's program are extremely grateful for the efforts that you've made from the Fed to connect with the academic community. And we are especially lucky to have you here today to help us celebrate Art and celebrate Art's prolific and influential career. So thank you and welcome. How are things in DC?
Things are good.
Good. Mark, so you were breaking up a little bit there, but I will assume that's the cicadas who are attacking.
Can you hear me?
That's better now. Yeah. Good. So, Mark, what I'd like to do today is to ask you about some of the broad themes that Art has highlighted in his research throughout his career. Mark, are you there? It looks like your video may be frozen.
Hear me?
Mark, it's very choppy. Do you want to try to log off and log back on, see if you get a better?
Yep, yeah, we'll try. Okay.
All right, give us a moment while Mark tries to reset the internet. Mark, it looks like it may be working now. Mark, do you want to give this a try? It looks like you may be.
Can you hear me?
Yeah, I think you're.
Can you hear me?
Yeah, I think you're better now. All right.
Okay.
Good to go?
Hopefully it works.
Okay. All right.
Yeah.
So I want to start off with a general question about bank size, right? Art's book is called Taming the Megabanks. 25 years ago, the 5 biggest US bank holding companies had assets that were equivalent to about 16% of US GDP. Today, the 5 biggest US BHCs have assets that are equivalent to 50% of US GDP. JP Morgan is on track to become the United States' first $4 trillion banking organization by the end of the year. Art says that really big financial conglomerates are problematic for a number of reasons. Art says really big banks create systemic risks. Art says really big banks reduce competition. Really big banks wield outsized political influence. So my question for you, Mark, is are today's banks too big? And if not, how big is too big?
Thanks for that question, Jeremy. Is my audio and video okay now?
I think we're good.
All right, hopefully we're stable. Thank you to Erik and the conference sponsors for inviting me to participate today to honor the work of Art Wilmarth. And let me start by saying that my remarks today are those of my own and may not reflect the consensus views of the board staff or the Board of Governors. In general this morning, Jeremy, you're going to hear me, I think, defend the inertial state, not every jot and tittle of the inertial state, but in the main. At a high level, I think Congress made a generally understandable and defensible decision in 2010 to neither nationalize nor break up the largest US banks. Instead, Congress instructed the Fed and the other banking agencies to regulate and supervise the largest US banking firms much more strictly, so as to force the firms to internalize the negative
Mark, you're starting to cut out again.
externalities of their size. They had the 2008 crisis. They had more than double the amount of total loss absorbing capacity, had more than triple the levels of high quality liquid assets on the asset side of their balance sheets, and had roughly half the levels of short-term wholesale funding on the liability side of their balance sheets. Over the last decade, the largest US banks have also become substantially more resolvable in the event of their failure, with starkly more gone concern loss absorbency, a workable statutory resolution regime, and an effective single point of entry bail-in recapitalization strategy. As a result of this work, the rating agencies have removed ratings uplift for government support from all the US GSIBs, or global systemically important banks. Before the 2008 crisis, the largest US banks had the lowest capital ratios among US banks, 3 to 4 percentage points below those of smaller banks. Today, the largest US banks have capital ratios roughly equivalent to those of smaller banks, despite their greater geographic and business line diversification. Importantly, we've calibrated this new capital framework for the systemically important US banks to offset any damage to the US economy that might be caused by their failure. So if a systemic bank, for example, would cause 10 times more damage to the financial system upon failure than a regional bank, we make that systemic bank hold an amount of extra capital so that its probability of failure is 1/10 that of the regional bank. We negotiated an international agreement on capital surcharges for the GSIBs, but the Fed did not think that framework was tough enough. So we imposed surcharges on the US GSIBs today that are about 50% higher than those required by the international framework. These bank regulatory reforms adopted in the wake of the 2008 crisis have paid serious collective welfare dividends. In significant part due to their increased resiliency, large US banks served as critical shock absorbers in the COVID event. They were able to grow their balance sheets tremendously during the dark days of spring and summer of 2020, receiving large deposit inflows and providing credit lifelines to consumers, businesses, and municipalities. Fundamentally, large US banks, like smaller US banks, were a contributor to the solution in 2020, very unlike 2008. On the issue of kind of raw concentration, some other statistics that I think are useful to look at, in addition to the ones that you pointed to. If you go from 2008, from the great financial crisis to the eve of the pandemic, the total assets of the 8 US systemic banks declined as a percentage of total US banking system assets. So at least by this pretty important measure, over the last 12 years or so, banking sector concentration in the US has actually fallen. In addition, if you take a global perspective on concentration, I think that's also useful. The ratio of large bank assets to GDP is much smaller in the United States than in Europe or Asia. So again, the US banking system seems much less concentrated when you compare it to other foreign major banking systems. So given that fact, these factoids and some of the other developments over the past 12 years or so, would directing the biggest US banks today to get materially smaller, materially reduce financial stability risk? I think it's not clear. In part, this is because size is only one element of a bank's systemic footprint. Systemic footprint also comes from other sources, such as interfinancial exposures, cross-border exposures, lack of substitutes, and short-term wholesale funding. And it's worth recalling that Bear Stearns was a systemic bank at a mere $400 billion in assets. That's less than 1/8 the size of JP Morgan today. Crucially, final point, we currently make the 8 US GSIBs hold about an extra $200 billion of common equity and about an extra $800 billion of gone concern loss absorbency because of their outsized systemic footprint. So that's about $1 trillion of extra loss absorbency in the banking system from these systemic surcharges. If we were to forcibly shrink the biggest banks, make them non-systemic, it'd be hard to justify that extra $1 trillion of loss absorbency in the system. So even if you thought it made sense back in 2008 to break up the big banks, the question's harder now because of all the regulatory stringency we apply to the systemic banks.
So let me pick up there and ask you about Art's proposal to reinstate Glass-Steagall's structural separations, right? Because Art is concerned about size, but he says there's also a lot of other problems that come along with mixing commercial banking on the one hand with investment banking and insurance on the other hand. Art says, in addition to the size-based issues that I mentioned before, reinstating Glass-Steagall could also reduce conflicts of interest within a financial conglomerate. Reinstating Glass-Steagall could mitigate culture clashes between a commercial bank subsidiary and an investment bank subsidiary. So what do you think about, notwithstanding the size-based issues we've already talked about, reinstating Glass-Steagall to address some of those culture-related issues?
Yes, second great question, Jeremy. Again, I think Congress got this mostly right in the Dodd-Frank Act. In the wake of the great financial crisis in 2008, Congress decided not to resurrect the Glass-Steagall Act, but instead to ensure that the trading activities of large banks were much more tightly constrained. I suspect Congress made this decision for a number of reasons. First, that the ability of commercial banking firms to engage in a broad range of financial activities, including investment banking and trading, didn't really contribute in a meaningful way to the 2008 financial crisis. Most of the firms that failed or approached the brink of failure back in 2008 were fairly specialized firms, mortgage firms such as WAMU, IndyMac, Freddie Mac, Fannie Mae, standalone investment banks like Bear Stearns and Lehman Brothers, or unique insurance firms like AIG. There were some troubles at the diversified universal banking firms as well, but I think the troubles of those universal firms that combined commercial banking and investment banking were not really caused in important ways by their combination of commercial and investment banking under the same corporate umbrella. Most of their problems stemmed from poorly underwritten loans. Losses from lending activities in 2008 and 2009 were much more severe for the banking system than losses from investment banking and trading. Second, at a high level, the existence of diversified financial services companies does provide net benefits to the US financial system. There are meaningful synergies and economies of scope in operating a commercial bank in tandem with an investment bank. In part because of those synergies, currently every large global investment bank, including all the large US investment banks now, are affiliated with a commercial bank. Universal banks do promote customer welfare because many non-financial businesses prefer the convenience of a one-stop financial services shopping. In addition, I think diversification across business lines for large banks reduces the volatility of their performance. We saw this pretty starkly in 2009 and 2020, as the largest US banks had tremendously good investment banking revenues that offset some significant write-downs on the commercial banking is quite successful and investment banking is slow. So there's quite a significant amount of diversification benefits there. You mentioned some of the conflicts of interest that are possible when you combine an investment bank and a commercial bank together. Those are there, those are true. But we do have a fairly well-developed set of legal restrictions to mitigate those conflicts of interest, including federal restrictions on transactions by a commercial bank with its affiliates and special federal anti-time restrictions that are applicable to commercial banks. All that said, securities and derivatives trading are high-risk activities in many respects. And if we're going to let commercial banking firms engage in these activities, they need to be quite strictly regulated, a lot more strictly regulated than in 2008. And today they are. The Fed and the broader US financial regulatory community have substantially stiffened the supervisory and regulatory framework around securities and derivatives trading. There have been 4 key elements of this nouveau regime that I'll just mention before I close. The first is risk-based capital requirements. The risk-based capital requirements for bank trading books have more than doubled since 2008, and they've been made less pro-cyclical. The second one is large US banks now face a tough global market shock as part of the stress test that the Fed does every year. Third, we've got new liquidity regulations, the liquidity coverage ratio and the net stable funding ratio, and they now require commercial bank affiliated investment banks to employ substantially more stable funding for their trading portfolios. And then lastly, we have central clearing requirements and margin requirements that have sucked a lot of counterparty risk out of the derivatives markets. So as a result of all those regulatory changes, big US and global banks have smaller trading books, have much better capitalized trading books, and much more durably funded trading books than they had in 2008.
So if I could follow up on one component of what you just said, you mentioned the Federal Reserve's restrictions on transactions with affiliates under Section 23A of the Federal Reserve Act. This is the provision of law that is meant to prevent federal subsidies from seeping out of depository institutions, subsidiaries to their non-bank affiliates. Art has contended in his work that enforcing and supervising compliance with Section 23A is hard, and that during a crisis, there's always going to be pressure to waive restrictions of 23A. I think we did see some exemptions that the Fed issued in conjunction with the sister banking agencies during the spring of 2020. There are some legal interpretations that you posted on the Fed's website, allowing banks to absorb assets from their broker-dealer affiliates and from their money market fund affiliates. Would you like to comment on the extent of, comment number one on how well Section 23A works, number two, the extent of any exemptions made last spring, and number three, the status of any Reg W revisions that the Fed may be working on?
Yep, happy to do that, Jeremy. So I think 23A is pretty easy to enforce. It's a fairly simple rule. Others may disagree with me on that, but I think it's a fairly simple, fairly concrete, fairly objective rule that is easy to enforce in ordinary times. It's not a perfect rule. It doesn't plug any possible way that subsidy can flow from a commercial bank to an investment bank affiliate. But it's a pretty good regulatory regime, pretty solid. You are quite right, both in 2020 and in 2008, when we were in times of severe financial stress, one of the first things the Fed did was to provide some exceptions from 23A to better enable the large commercial banks to provide funding to various different affiliates of those commercial banks, including dealer affiliates. We did think that was an important thing to do as we were trying to channel liquidity throughout the entire financial system in a time of severe distress. But at the same time, I think it's also useful to know that those 23 exceptions were not used in a very substantial way. They were granted, and some banks did use them, but they weren't a major prong of the Fed's response. They weren't utilized a large amount by different banking organizations. One of the things I have to apologize the most for in these sorts of public settings is not having completed our Reg W regulation that I think Dodd-Frank really told us we needed to do. Dodd-Frank made a number of important changes to 23A, including rolling derivatives more clearly into the 23A framework. We have not yet completed a rule to implement those provisions. It's on our list of things to do. I'm hoping that we'll get to it very soon.
Thank you. So let's talk about shadow banking. Right. So the Glass-Steagall Act, which is the focus of Art's book, not only separated commercial banks from non-banks, but it also prohibited non-banks from accepting deposits. Right? And that part of the law, Section 21, is still on the books, but Art says that it is under-enforced. Right? There's a big part of Art's book where he talks about the ways in which federal regulators have interpreted Section 21 to allow non-banks to issue deposit-like substitutes in the form of repo and commercial paper and money market mutual funds, all markets that have now experienced repeated stresses and twice in the span of 12 years. So Art's proposal is that Section 21 should be amended to better define deposit, to include all short-term money that is redeemable at par within 90 days. Right? So Art thinks that all short-term funding redeemable at par within 90 days should be issued by banks, and that non-banks should not be able to issue such instruments. What do you think of the current state of short-term funding markets? And perhaps if you'd like to comment on that specific proposal by Art, whether that would be a desirable reform.
Let me just comment very briefly on the Glass-Steagall Act, and then move towards more of a discussion of kind of some of the risks that we see in shadow banking markets. Section 21 of the Glass-Steagall Act is still on the books. Art is right. Most of the provisions of the Glass-Steagall Act have been wiped away, but not all, and that is one of the remaining provisions. I think it hasn't gotten a lot of use over the past few decades because of the nebulousness of its current drafting, but it certainly could be drafted in a different way to be more clear about what kinds of deposits and deposit substitutes require to be regulated as a certain kind of bank. But I won't comment on the pros and cons of any kind of amendments that people might propose to the Glass-Steagall Act. I will say, though, that we are quite focused at the Fed on the continuing ongoing risks in the short-term funding, shadow banking, non-bank financial intermediation space. We saw in March 2020, once again, that short-term wholesale funding markets can be quite unstable under stress. We saw investors and creditors running on a wide range of investment funds, and we saw those investment funds engaging in fire sales of assets to meet investor redemptions and to meet margin calls from creditors. We saw this phenomenon in lots of different places. We saw it in money market funds. We saw it in bond and loan mutual funds, mortgage REITs, some hedge funds that employed a variety of different treasury arbitrage strategies. We also saw tremendous dislocations in global dollar funding markets. So sum it all up, and I think there still is a moderate amount to worry about in short-term wholesale funding space. I'll just mention kind of a few key areas of anxiety for me, the first three of which are also highlighted in the board's May financial stability report. First, I think we should continue to worry about liquidity transformation vulnerabilities at money market mutual funds, prime and tax exempt. A money fund, as you know, engages in liquidity transformation by offering daily redemptions to investors, even when the fund's underlying assets may be difficult to sell quickly. The President's Working Group on Financial Markets released a report in December 2020 outlining potential reforms to address risks from the money fund sector. It's a good read. And the SEC recently sought public comment on money fund reform options as well. If properly calibrated, some of these reforms could significantly reduce the run risks associated with money funds. I'd also note we should take a look at money fund adjacent vehicles. There are lots of other cash management vehicles out there, such as dollar-denominated offshore money funds and short-term investment funds, or STIFs, which also experienced heavy redemptions in March of 2020 and remain susceptible to runs. Second, I think we should worry about open-end mutual funds that invest in illiquid assets. Mutual funds that invest in corporate bonds and bank loans, for example, have grown massively over the last decade and are exposed to some of the same liquidity transformation risks as money funds. The record outflows from these funds in March 2020 highlighted, I think, the continuing structural vulnerabilities in that sector. Third, I flagged the short-term US dollar borrowings of foreign banks. The dollar-denominated business of foreign banks has increased materially over the past decade as well. Foreign banks in general depend more on wholesale funding markets to finance their dollar assets than do US banks. While the adoption of liquidity requirements by the Fed has improved the resilience of some of the US subsidiaries of foreign banks, more and more of the US dollar activity of foreign banks has gravitated toward their US branches and to offshore booking locations. What we saw in the spring of 2020 was that stresses in the money markets reduced access by foreign banks to US short-term wholesale financing, while the cost of offshore dollar financing spiked. And at the same time, the dollar funding needs of foreign banks jumped as US customers drew on credit lines. The Fed's dollar liquidity swap lines with foreign central banks relieve stresses in those markets, but some vulnerabilities here remain as well. Last thing I want to mention is we are focused on monitoring the risks around stablecoins and other nascent forms of private money. A stablecoin is a digital asset whose value is linked to traditional assets, traditional stores of value like fiat currencies or gold. Stablecoins are often redeemable on demand for fiat currency. But unlike central bank money, stablecoins do not have legal tender status, generally don't benefit from the same level of protection as FDIC insured bank deposits or Federal Reserve notes. And if they're widely adopted, and some stablecoins have the capacity to scale up quickly, stablecoins could serve as the basis of an alternative payment system oriented around these new private forms of money. Stablecoins, despite their label, are likely to be more volatile than central bank money and FDIC-insured deposits, and they may face run risk in times of stress. I think the free banking era in the middle of the 19th century provides a cautionary tale there. So those are some of the areas that we're focused on.
If I could ask a quick follow-up, since you mentioned foreign banks and liquidity risk at their US branches, Governor Brainerd has called for standardized liquidity rules for foreign bank US branches. I think Vice Chair Quarles has said he would rather explore that through international coordinating bodies. Any updates for us on liquidity rules for US branches?
No interesting updates for you today. It's not something that we're working on domestically actively, but it is on our longer list of things to do. It is something that we're consulting with our international interlocutors on.
Thank you. So in our time remaining, I'd like to ask you about the separation of banking and commerce, right? Art has been a steadfast supporter of separating banking and commerce. He wrote the definitive account of Walmart's ILC application back in 2005, 2006. We have an entire panel later today that Solio Morova will moderate about the separation of banking and commerce. The Fed institutionally has generally agreed with Art's concerns about maintaining the separation of banking and commerce. But recently, we've seen the renewal of ILC applications and new ILC charters. We've seen the OCC begin to explore and begin issuing new charter types like the Fintech charter. And these newer non-traditional charter types might not only threaten the separation of banking and commerce, they could threaten the Fed's ability to conduct consolidated supervision and regulation. So I'd be curious for your reactions about these charter types specifically, and about the current state of banking and commerce and how they interact.
Yeah, happy to dilate a little bit on those issues. The past few years, as you indicate, have seen something of an explosion of interest by fintech and big tech firms in the banking business. I've been pleased to see a number of fintech firms establish or acquire a full service bank, regular way, but there haven't been too many that have done that. We've also been carefully assessing a host of different proposed partnerships between banks on the one hand and fintech or big tech firms on the other hand. As we assess those partnerships, we try to make sure that the bank partners do sufficient due diligence on their tech partner, that the bank partners have sufficient control of the relationship, and that the partnerships don't create outsized risks to the bank. But in addition to these sorts of partnerships, we also have seen, as you noted, the emergence or reemergence of a wide variety of special purpose quasi-bank charters. You kind of listed off some of the types. It includes the special purpose national banks, industrial loan companies, state chartered cryptocurrency banks, and many more. These non-bank banks typically seek to provide a subset of banking services under a charter that's subject only to a subset of the rules in the bank regulatory rulebook. Many of these non-bank banks need access to a Fed master account and services to apply their intended trade. Under the law, the Fed has substantial discretion in its decisions as to around granting accounts and services to non-bank banks. And we continue to assess our legal eligibility standards and our policy principles for granting such access. Just a few weeks ago, the board issued for public comment some proposed policy guidelines for how Reserve Bank should analyze requests for access to Fed accounts and services. And the board's also considering whether it should provide clarity around the legal eligibility standards for receipt of a Federal Reserve account. You flagged the issues of consolidated supervision and banking and commerce. Many of these special purpose bank charters would allow a firm to avoid consolidated supervision of its operations and to combine banking and commerce under the same corporate umbrella. From a public policy point of view, the Fed's had a longstanding institutional anxiety, I guess I could say, about lack of consolidated supervision for material banking groups and about excessive entanglements between banking and commerce. And I think we've had some good reasons to support those views. On the consolidated supervision front, history, I think, has demonstrated repeatedly that financial trouble in one part of a firm can spread rapidly to other parts of a firm. Financial firms typically run their businesses on an integrated basis that transcends legal entity boundaries. Supervision that's focused just on one subsidiary can easily miss risks that cross legal entities and that are managed by the group on a group-wide basis. So I think Congress established a consolidated supervisory framework for bank holding companies and thrift holding companies precisely for this reason. And this framework allows the Fed to understand the financial and operational risks across the entire firm and gives the Fed the ability to identify and resolve significant problems within the overall firm before they pose a risk, danger to the subsidiary bank. I think it's telling that most other developed countries, more and more over time, including the European Union, the UK, Switzerland, and Japan, they've adopted a consolidated supervision framework for their banking firms too. And at this point, I'd say consolidated supervision is now safely ensconced in the Basel core principles and has become the dominant approach to supervision of banking groups worldwide. Similarly, on the banking and commerce front, Congress has had a longstanding preference to separate banking from commerce. And you can see that it's made manifest in the original Bank Holding Company Act in 1956, the Bank Holding Company Act amendments of 1970, the Competitive Equality Banking Act of 1987, and the Gramm-Leach-Bliley Act in 1999. The American tradition of separating banking from commerce has been motivated by several high-level concerns. One is the risk that allowing banking and commerce to mix will result in an extension of the federal safety net to commercial affiliates and make banks susceptible to the risks of their commercial affiliates. Another concern is that banks affiliated with commercial firms may be less willing to provide credit to the competitors of their commercial affiliates, or may provide credit to their commercial affiliates on favorable terms. Moreover, I think Congress has expressed concern that allowing banks and commercial firms to affiliate could lead to the concentration of economic power in a few very large conglomerates. But whether you root for the preservation of the traditional American banking system or cheer for the tech-enabled disruptors, I think one thing is very clear. This outside-in pressure of non-bank companies in pursuit of a bank charter or bank partnerships, it's building rapidly. And it'll be fascinating to see how Congress, the regulatory system, and the banking sector respond to these pressures. At the current conjuncture, the outcome seems unclear.
Well, thank you, Mark. We will pick up on those themes later today with our FinTech and separation of banking and commerce panel that Solly will lead. Let me just reiterate what I mentioned at the outset, which is, Mark, we are so grateful for the efforts that you have made to reach out and have a dialogue with the academic community. Over the years since you've taken over as general counsel. So thank you for maintaining that connection with us, and especially for being here today to honor Art's legacy and all of these ideas that he has helped elevate to part of the national discussion. So thank you, Mark, very much for kicking us off today. And let me hand it back to Erik to move us to the next panel.
Thank you very much, Mark and Jeremy.
Thank you.
That was incredibly insightful, and we appreciate you both spending time out of your busy day. So thank you both. We are waiting for Senator Brown to log on, so we might take a few minutes break. Let's stay tuned until he gets here. You can see in the upper corner of your screen the man of the hour, or the man of the entire day, Arthur Wilmarth. We are going to make sure that Arthur gets lots of love and lots of embarrassment. We're going to see him blush throughout the day. So just hang with us for 1 minute while we wait for Senator Brown. So for those of you in the audience who are just joining us, we're waiting for Senator Brown to join us. And then Professor Wilmarth will, as soon as he does join, Professor Wilmarth will introduce him and we'll get started again. So my apologies, Senator Brown, for technical problems. I think
I'm here now. Professor Gerding, Professor Wilmarth, is it working?
I'm so sorry for the technical problems, Senator Brown, but Professor Wilmarth will now introduce you.
Good, it doesn't matter, so we're on, thank you.
Many thanks, Eric, and thanks also to the Colorado Law Review for sponsoring and hosting this conference. I would like to express my tremendous appreciation and gratitude to everyone who's participating in the program today. Now it is my great privilege and honor to introduce our keynote speaker, Senator Sherrod Brown of Ohio. Senator Brown became chairman of the Senate Committee on Banking, Housing, and Urban Affairs in January of this year, after serving as ranking member of the committee for 6 years. Senator Brown was first elected to the Senate in 2006, and he served previously as a congressman, as Ohio Secretary of State, and as a state legislator. Senator Brown grew up in Mansfield, Ohio, a mid-sized city located about 200 miles west of the town where I grew up in northwestern Pennsylvania. Mansfield was also the hometown of Senator John Sherman, author of the Sherman Antitrust Act of 1890. Senator Brown's determined efforts to combat excessive concentrations of economic power and political influence are very much in keeping with the antitrust principles established by Senator Sherman. I first met Senator Brown at a Senate subcommittee hearing in December 2011, when I was honored to speak on a panel that included Sheila Bair and Simon Johnson. Senator Brown walked over to the hearing table to greet me before the hearing began. His friendly and down-to-earth manner made a very deep impression on me. I admire Senator Brown because he exhibits the same qualities of character I observed in my parents: honesty, humility, kindness, courage, and a genuine care for others. Throughout his career, Senator Brown has been a steadfast champion for workers, manufacturing enterprises, small businesses, local communities, and local banks. Senator Brown's priorities should be at the top of our agenda today, when our society is increasingly dominated by big finance, big tech, and a relentless drive toward automation that threatens to treat people as mere collections of data points. During the Senate debates on the Dodd-Frank Act, Senator Brown and Senator Ted Kaufman sponsored an amendment that would have placed maximum size limits on banks. The Brown-Kaufman Amendment would have forced the 6 largest US banks to break up. That amendment attracted 33 votes, but unfortunately did not pass due to the determined opposition of megabanks and the Treasury Department. In 2013, Senator Brown and Senator David Vitter of Louisiana introduced a bipartisan bill that would have required large, complex banks to satisfy a minimum leverage requirement of 15%, 3 times higher than the present standard. The Brown-Vitter bill would also have established a strong regime of risk separation between large banks and their capital markets activities. Although the Brown-Vitter bill was not enacted, I believe that it remains a landmark precedent for future financial reform efforts. I am deeply grateful to Senator Brown for being with us today and sharing with us his thoughts on regulating megabanks and other large financial institutions. Please join me in welcoming Senator Brown to this program.
Thank you. Thanks so much, Professor Wilmarth, for the generosity of spirit in your introduction and your reference to your parents. And I can't think of the last time I've been introduced when Senator Sherman, of Sherman antitrust fame, was invoked. So thank you for doing that much research that you knew that. There was a middle school in Mansfield named after him, but he's mostly been forgotten by that community and by many people, but I appreciate your bringing him up. But more importantly, Professor Wilmarth, thank you for your work. As I've watched your work for more than a decade now since you're testifying that day, and you're devoting your career to holding Wall Street accountable to the people who make our country work is so important. So thank you very much. Thanks for having me at this. And I will not speak long, but I will want to put some thoughts and ideas out there. And I thank all of you watching, that your research and your advocacy and standing up some of those powerful people in the country is so important, especially as we've seen the power of the elite in this country, the power of Wall Street and what it's done to working families. This Wednesday, day after tomorrow, we're bringing the CEOs of the 6 largest banks to testify before the Senate Banking and Housing Committee. This committee has always been referred to by people around the Capitol as just the Senate Banking Committee, or just Banking Committee or Senate Banking. And it's been, frankly, as you could tell from Professor Wilmarth's introduction, it's been way too much about Wall Street and very little about community banks, very little about housing, and almost nothing about people's daily economic lives. And that's the past. We are going to move forward in a very different way. I always refer to the committee now as Senate Banking and Housing, sometimes Senate Housing and Banking. And it's important that we focus on that. But this, in terms of this Wednesday, it'll be the first time we've ever had the large banks testify together to be held accountable. Their decisions affect the lives of millions of people. I'm going to say at the beginning of the hearing, they're the 6 most powerful economic players in our country. Their decisions, as I said, affect the lives of millions of people, their paychecks, their job opportunities, their retirement savings. And as you know, these banks, and suggested by Professor Wilmarth's introduction, these banks' power is so much greater than it was when he grew up in Western Pennsylvania and I grew up in North Central Ohio. Art's work and the work of so many of you listening has been instrumental in illustrating that, in shining a light on the ways the financial industry has changed and how its tentacles stretch into many of the biggest problems in our country. I look at places like where I grew up. He mentioned Mansfield, Ohio, an industrial city of more or less 50,000, halfway between Cleveland and Columbus. Jobs shipped overseas to countries where you can pay workers less, declining union membership by design, crumbling roads, shuttered storefronts, workers forced to choose between the hometown they grew up in and they loved. I went to Johnny Appleseed Junior High. What's not to like about that? And leaving that community in search of opportunity. Companies like Westinghouse and Fisher Body and Tappan Stove and Mansfield Tire, and I could name a dozen more. Companies closed down one after another. They weren't replaced by new investment. The creative destruction the market fundamentalists like to talk about wasn't followed by any construction, creative construction or otherwise. That was all before 2008. As you know, you all know better than most how the problems that may not seem connected whether it's foreclosure in my zip code in Cleveland, my zip code 44105, where Connie and I live, had more foreclosures in the first half of 2007 than any zip code in the United States, or layoffs at a big retail chain, or a private equity firm buying up a trailer park in Iowa and raising rent. You all know how Wall Street system is really behind all of this. And your work is so important to illustrating it. That's why Art's work, that's what Art's work really does so well. His book is an important tool to fight the collective amnesia that's set in about the financial crisis. It's a reminder of how government can be a force for good in people's lives. We know government. We did a hearing, first time ever in this committee, maybe 6 weeks ago, about structural racism in housing, from black codes to Jim Crow to redlining to Trump administration locking in discriminatory housing. We know the role of government has been oftentimes negative, but we also know the role of government can be something else. I read and write a lot about history and progressive history, and we're hearing a lot about the New Deal now. We're hearing mostly about it regarding government investment in jobs and infrastructure and our social safety net. All that is critical. We recognize the shortfall of the New Deal, and the shortfall was that it left out people of color, essentially, by its continued forced segregation policies. But we know how, as we see Congress move and the president propose, and we move on these issues, we know it's critical to go big. We've already started the American Rescue Plan, shots in arms, money in people's pockets, kids back in school, people back in jobs. The financial parts of the New Deal, like Glass-Steagall, often get left out of these conversations today about what's next. But all the ways the New Deal put guardrails on finance, all those were critical to the entire project. The New Deal was about rebalancing the power in this country to put workers, the people who drive our economy's success, put workers at the center. In this, especially now, is workers of color. We did it by creating social insurance, unemployment, ultimately Social Security, unemployment insurance, Medicare later. And we did it by empowering unions, by taking on Wall Street. We created the strongest economy and largest middle class the world's ever seen. Too many Americans were left out. As I said, labor protections didn't apply to the professions that many women and Black Americans worked in. Foreclosure prevention programs discriminated against Black homeowners. What we needed in the following decades, and what we still need today, wasn't to tear up the deal bit by bit. What we've needed for decades is to expand it everyone, to women and to people of color who were left out, and to update it for how people can live and work today. But you all know what happened. History, one of my favorite quotes about history is Emerson said, history is a battle between the innovators and the conservators. The innovators are people like Simon Johnson in this call and others that have fought to move this country forward as progressives. The conservators are people that held their power and their money and didn't want to give it up, the special interests, the banks. It took decades for the pain of the Depression to recede from people's memories, but little by little it did. And the big banks seized their opportunity, aided and abetted by Milton Friedman and crusaders for the so-called free market that you all know was never really free. More and more people are beginning to learn these lessons. We know we can't let this history repeat itself. The administration and progressive leaders are making it clear, if we want shared prosperity, we need bold government action. If we want a safe and sound banking system, government's going to have to provide smart regulation and tough oversight. You all play a part in fighting back. You document this history. You help us illustrate how the Wall Street system and how all the rule rollbacks hurt our economy and hold us back. As you work on your research, allow me to make just one suggestion. The statistics you provide are so important. You'll hear me cite some on Wednesday at this hearing about how the CEO to worker pay has just exploded, about how fewer and fewer Wall Street funds are invested in the real economy, creating real jobs. We need more than numbers, though, to fight back. We need you to tell stories. One story just that I can't get out of my mind. We did a dignity of work. It wasn't really a hearing. We just had a number of workers talk to our committee. One woman from West Virginia, woman who probably was in her middle age, late middle age years, and she said working poor shouldn't be in the same sentence. That so many people are working so hard and not getting enough of it, so not getting enough of the American dream. So I encourage you to do more, to do more case studies, visit the towns, talk to the workers who have gotten hurt the most by Wall Street, tell the stories of the towns where a private equity fund bought the largest employer and now hundreds of people are out of a job. Tell the story about how people feel the pain from decisions get made in boardrooms hundreds of miles away, but don't realize why they've lost their job, why their wages are low, why their employer is fighting their union. So often people don't make that connection. You can make it with data and storytelling. Policymakers who care, who want to take on these powerful interests, need to be able to illustrate for people why this matters. Not some resentment based on race, not some anger based on something that's not on a political leader dividing people in this country on race or on gender or on any number of factors. We need every tool. We need every ally. And we know the banks are big and powerful. We know they can unleash their lobbyists. We know what we're up against, but we also know on this call led by Art and so many of you, we know that there are smart, dedicated people. People like my former staff member, Graham Steele, you'll hear from later, like others on this panel today. We need you in this fight. I'll close with this. Every year in the spring, I ask 6 of my colleagues, 3 Republicans and 3 Democrats, to come to the Senate floor and read. We divided into 7 pieces, the 3 Republicans, 3 Democrats, and I. The Dr. King's letter from the Birmingham jail in 1963. You may remember, I'm sure all of you in this call have read this letter. It doesn't hurt to read it again. I've read it. I hadn't read it for years and went back to it when we started this tradition. And as you know, Dr. King was admonishing the moderate ministers, the moderate white ministers who were his allies, who said, Dr. King, we support voting rights, but not too fast. You've got to have patience. And Dr. King wrote this letter from the Birmingham jail. And my favorite line in the letter is when Dr. King said, progress never rolls in on wheels of inevitability. Progress never rolls in on wheels of inevitability. He knew it took activism. It rolls in because of Americans like you who take on powerful interests, who challenge the status quo, who dedicate your lives to progress. That's what Art's done with his writing this book and previous writings. It's what my friend Graham Steele and Simon Johnson and others on these panels today have done. It's what so many of you have done in your law schools, in your communities, on the streets. Keep doing it. We need you. Help us with the stories. Help us convince the American public that we're on their side, because surely we are, and we will make their lives better. So Arthur, thank you, sir. I appreciate the chance to be here.
Thank you so much, Senator Brown. It's really an honor and pleasure to hear from you. If you have time for a couple of questions, I wondered if you would comment on this view that during the pandemic of 2020, the big banks proved how resilient and successful and reformed they are, because it struck me that the Fed rushed in with even more ammunition, with even more aggression than they did in 2008, this time even bailing out the bond market. I don't see the pandemic crisis as being a time of celebration for the big banks when they stood up and saved the country. What is your view on what happened during March of 2020? Yeah,
the big banks over the last 13 months continued. The community banks, many of the big banks, one in particular cut its lending by 14%. That may come up in our hearing. The community banks actually increased their lending, as you know, in the aggregate about 10%. And we know other things were going. We know that the big banks did stock buybacks. The big banks did major dividend distributions. The Fed, in spite of many of us imploring the Fed, didn't really stop it, but could have. So the banks, as the banks came out of 2008, I mean, as I said, I saw what happened in my neighborhood, and I've seen what happens in my city. My city is the declines in Cleveland, the problems with lost population and lost industrial jobs, and all started way before the most recent, or the 10-year ago financial crisis. But we saw this decline, but we see the banks coming out of 2008 more and more profitable, and we see the large Wall Street banks right now continuing their profitability and their success. And they've they've learned nothing in terms of investing back in communities and sharing the pain, shall we say.
And then one final question. Obviously, Fintechs, many owned by commercial enterprises, the big technology firms are definitely exploring various ways of getting into the banking business without accepting the full burden of banking regulation. And we see efforts by the FDIC and the OCC to make that happen through the ILC charter and the so-called FinTech charter. What does your committee think about this problem of the erosion of the wall between banking and commerce, which in many ways played the same role as the erosion of the wall between banking and capital markets activities?
Yeah, we are seriously looking, and I think we'll have support on the ILC issue, some FinTech issues. But I think more than we're looking at closing that loophole, and we will have some interesting allies in that fight, Art, as you know. But the best news was just 2 weeks ago, we did something that Congress hasn't done in 15 years. That is that after the OCC rule of allowing payday lenders to form partnerships with federally regulated banks, the OCC deregulation universe, if you will, we know that they would come in and bust interest rate caps of 36% and state after state of state. In fact, in some cases, they were 36% ballot issues. They weren't just legislatures. So we moved to overturn that rule on the floor of the Senate. We won, we got 53 votes. We had 52 votes. One Democrat was absent. We got every Democrat and 3 Republicans. We overturned that rule. It was the first defeat for payday lenders on a Senate roll call vote in 15 years. The next step is what we do to impose that 36% interest rate nationally. Many states have enacted it. We want to see a national cap. Senator Reid from Rhode Island is led on this. We do have a national cap on loans to veterans, and that's a good thing. But why should it just be veterans who get that consumer protection? So it's a major step. Didn't get a lot of attention, but it was a vote in the Senate. As I said, we got 3 Republicans, and we expect to get more on the interest rate cap as we move forward on this.
One final question. In the securities markets, we've seen, I think, a great erosion of the public markets. You've mentioned private equity and how private equity has taken over more and more and more of the financing activity. We've also seen the SEC greatly expand private exemptions from the public offering rules. We've seen the rise of SPACs instead of traditional IPOs. Is the committee concerned about the erosion of our public securities markets with the transparency, the market discipline, the investor protections that they bring, and this moving of securities activities and indeed trading to dark pools, dark corners, sort of inside deals, controlled deals by people like private equity firms and SPAC organizers?
Yeah, the short answer is yes. The longer answer is this committee's 12 Republicans and 12 Democrats, and we need persuasion. We need persuasion from people like you on moving this. But I'm very happy with the new SEC chair, Gary Gensler. During my comments, I talked about telling stories and how important that is. And I was for a short period of time in early 2019, I explored the thought of running for president. I decided it's not something I really wanted to do. And I did what we called our Dignity of Work tour. And one of the stories I heard when I was in Iowa, and this was over just a period of a couple of months, was how private equity firms would come in, they'd buy up trailer parks, and people have the investment of their trailer. Essentially, it's not a house you can really pick up and move, even though you might think it is. They have their investment of their trailer, they're renting the land, and they pay for utilities, but they own their trailer, and it might be a $50,000-$60,000 investment. And this private equity firm comes in and jacks up their rent, and they are stuck. And it's they are a captive audience, if you will. There are things happening like that, and I mention that story because it's so understandable to people how it's just just as egregious as a private equity firm coming in, buying a profitable company in Mansfield, Ohio, and then shutting it down and cashing in. I mean, those are stories that are so important that if you can, all of you on this call, get these stories to public officials, and we'll win this debate, because it's clear their mission has not served the public interest. I'll just leave it at that.
Senator Brown, thank you so much for taking time from your very busy schedule to talk to us about, as you say, the really, I guess, really life and death issues, but tremendous public welfare issues. Many people think that finance is somehow separated from public welfare, and I think your career has shown how integrally connected good finance is to public welfare and the welfare of our communities and our nation. Thank you for the work you do. Thank you for the courage you've shown.
Thank you, Professor Wilmarth. Thank you for your incredible work, and all of you on this call. Thanks so much. Best wishes in conference today. Thanks. Thank you.
Thank you very much, Senator Brown, and thank you, Art, for introducing and asking a few questions. Thank you also to Senator Brown's staff for helping make this, and the staff of the Senate Banking Committee for helping make this his participation possible. We're now going to turn to a fireside chat featuring two amazing luminaries in the financial regulatory world. First, Sir Paul Tucker, who is the chair of the Systemic Risk Council. He is a fellow at the Harvard Kennedy School, and he is also the author of Unelected Power, The Quest for Legitimacy in Central Banking and the Regulatory State, which has been published by Princeton University Press in 2018. He asked me to keep the introduction short, so I will turn to the second member of our fireside chat, Professor Simon Johnson, who is the Ronald A. Kurtz Professor of Entrepreneurship at the MIT Sloan School of Management. Professor Johnson is also a member of this private sector Systemic Risk Council, which Paul Tucker chairs. Professor Johnson is the co-author with John Gruber of Jumpstarting America, How Breakthrough Science Can Revive Economic Growth and the American Dream. He's also co-written with James Kwok the best-selling 13 Bankers, The Wall Street Takeover, and The Next Financial Meltdown. So it makes me jealous that someone wrote a financial crisis book and it was best-selling. Professor Johnson and Professor Kwok later co-wrote White House Burning, The Founding Fathers, Our National Debt, and Why It Matters for You. He served previously as chief economist of the International Monetary Fund and has been on numerous advisory councils to government bodies, including the FDIC and Office of Financial Research. Moderating this fireside chat is my good friend and one of my favorite people in the Academy, Anna Gelpern, who is a professor at Georgetown University Law Center. She's the Anne Fleming Research Professor. She's also a non-resident senior fellow at the Peter G. Peterson Institute for International Economics. So I will now turn it over to Anna, who will moderate this fireside chat.
Erik, thank you so much. Thank you for putting this together and in a very art-like fashion, encouraging us to go deep and broad and not compromise in the issues we take on in our treatment of them. So since this is my one opportunity to say this, I just really wanted to thank Art and flag one element of Art's many contributions that hasn't come up yet, but I'm sure will many, many times. And so Art is a brilliant scholar and of course has been incredibly influential in the policy realm. But I can't help but think of myself, as I'm sure many of us do, as Art's student. Art is just the most brilliant teacher in the broadest, most general sense of that term. From his encyclopedic knowledge to his gentle and just generous encouragement and the decency and principled positions that he takes, his courage, all model scholarly and citizen behavior that I think we should aspire to. And I just can't thank him enough for that. And I'm thrilled and honored to be here to honor Art. Is someone monitoring the chat from Colorado Tech? If you could help us out there. Thank you. So I am especially grateful to Erik for putting me on this panel. It's a busy fireside, and I am incredibly honored to be here with two leading economists, Simon and Paul, who have been incredibly influential in this financial regulatory world and more broadly in central banking economic policy. And we have, 40 minutes to take care of the transatlantic perspectives on regulating megabanks. Small topic, no doubt. So mindful of the time, what I would like to do is focus on two elements of Art's thesis. Again, you hear this a lot, and I think it's really a tribute to both Art and Erik that we're able to explore these in depth. So the basic argument, right, that large universal banks are a problem when it comes to, in two senses, political power and financial stability, right? That both the size and the diversification, the ability to provide the wide range of financial services lead to undue accumulation of political power that both Paul and Simon have written about, and lead to financial instability. Is this the right diagnosis? How should we think about this with a view to solving the problem? And then in particular, how should we approach this from the transatlantic and perhaps broader global perspective, perhaps starting with Paul? Thank you.
Thank you, Anna. And well, this is a happy day. Congratulations, Art. It's really great to be here, and it's great to be on a panel with Simon. So yes, I think those corporate power and too big to fail are two good headings, but they alert us to something quite important, which I think will recur a bit. First of all, the problem of corporate power, of concentrated corporate power, which I think is really serious. If anyone doesn't think it's serious, it's worthwhile reading chapter 1 of the kind of novel come faction book that came out last year or the year before called The Order of the Day, which is about a particular meeting in 1933 in Germany. And that will tell you about the importance of corporate power. But the problem of corporate power isn't restricted to banking. And then on the second leg, too big to fail, the problem of financial stability isn't limited to too big to fail. So I would say very broadly, the problems of corporate power are not going to be fixed, and in some normative sense, should not be fixed by my successors at the Summit of Central Banking, because it's not a problem that is confined to banking. But I do think it's a pressing and vitally important problem, and we'll probably come back to that. Let me say something about financial stability. I think the most important thing I'm going to say in a way is I don't think the problem of financial stability is one for kind of technicians or specialists. I believe very strongly that the West, defined broadly actually to mean kind of liberal polities around the world, cannot afford another major or serious financial crisis at this point of world history with complicated, tense geopolitics. I think another financial crisis would be a very serious blow to the way of life that we've somehow contrived to establish over the past 300 or 400 years. And related to that, I don't think that financial stability is something that is of unique concern to progressives or social democrats, if you prefer to call them that, or conservatives, or to kind of centrist liberals. I rather think of financial stability, maintaining broad stability in the monetary system, as a precondition for achieving just about anything else. It's almost like an analog to having a working constitution in politics. That matters even more, of course. And I think this has a bearing in a way, and perhaps in ways we'll come back to, in some of the things that Senator Brown said. So that's a kind of register of how important I think it is. Just to get something quickly out of the way that, again, I suspect we'll come back to, that not only do I not think the problem is limited to too big to fail, I don't think the problem is limited to banks. The Senator and I just had an interesting exchange on 2020. Well, whatever one thinks about the big banks during 2020, it's kind of pretty clear that elements of shadow banking and capital markets were bailed out in the spring of 2020. And I don't think that's very surprising, because I think the problem of shadow banking has essentially been neglected over the previous kind of half decade or so. I mean, I kind of would say this, having left office at the end of 2013, but even at the end of 2013, there was still some prospect that there would be a general policy response on shadow banking, but it fizzled away. On too big to fail itself, I mean, this is a very special problem. I mean, the problem broadly is can the failure of a firm create systemic damage so that it ricochets through the financial system and unleashes severe social costs on society? It is important to say that almost any financial institution or group of financial institutions can cause such problems, so that in some sense being systemic is context dependent. What's special about SIFIs, systemically important financial institutions, which are too big to fail, is that it is almost impossible to think of circumstances in which their failure would not be systemic. That is what's special about them. And I think that's the best way of thinking about it. Dealing with the too big to fail problem, if it were ever dealt with adequately, would not deal with financial stability toto, but it is a necessary condition for dealing with financial stability. And of course, it is linked to the problem of corporate power in this particular sector, because very large banks have always been very powerful in the history of commercial society since the 18th century. That's why we know the names of bankers in the late 18th century and early 19th century. Why don't I stop there and hand over to Simon?
Thanks very much, Paul. Simon.
So thanks for the opportunity to be here, and thanks Erik and others for organizing this event to favor or honor art. It's a tremendous career accomplishment, Art. I think your latest book is absolutely terrific, and I'm looking forward to the next 5 books. So just keep hitting these highs, Art, please. I agree entirely with what Paul's saying in terms of the scope of the issues facing us, and particularly if we're going to focus on too big to fail, the megabanks. Dealing with them, I think, as Paul said, is necessary but not sufficient. And I would. I'm sure Paul said this because he's the clearest and most accomplished representative of this view. But let me just emphasize the cross-border dimension there, and the importance of having cross-border resolution in particular that could really function even at times of duress. And Paul obviously put an enormous amount of work into that. I don't know if it's been fully tested yet, but let's hope we never test it. But that's clearly a key item. I would like, though, Anna, to step back a little bit and reflect on what Senator Brown just told us, because I think that the problem we're trying to solve here, or the problem that we as academics and as people who spend a lot of time trying to think about what is the social interest, is actually broader, as Senator Brown said. It's really about good jobs, creating them, sustaining them, spread around the United States. That's obviously the US perspective, but there's a cross-border dimension of this also. And I think I want to question, in the spirit of Art, Wilmarth, I mean, maybe Art can chime in a cameo here and tell me if that's wrong, but in the spirit of Art, and remembering also, Senator Brown and Art both were talking about this particular hearing in 2010 or 2011 with Sheila, Bear, and Art and me. And I think this was a number of hearings I went to where there was a range of political views or ex-ante expectations of political views at the table. And actually, it turned out we were all in complete agreement that the way in which the financial system had evolved and developed prior to 2007, 2008 was not conducive with the kind of goals that any of us, Art or Sheila, and I remember going to similar hearings with Joe Stiglitz and with Tom Hoenig, but there was also complete agreement. So I think the question, Anna, is, if you wanted to design a system of finance to support more good jobs for more people, what would that system look like? And then if we make a little bit of progress on that, we could compare it to our actual system and what is presented to us as financial innovation or efficiency or whatever you want to call it. And I think these things would intersect, these visions would intersect relatively little. And I think that's a major, deeper problem here. I mean, I see Art, and again, Art can literally weigh in in this Zoom format, but I see Art as representing this view that markets should and could deliver prosperity, but markets have become distorted by the power of concentrated finance. I think we have to question, Anna, whether markets alone are going to do this, or whether there has to be some sort of overlay with policy at a deeper level. And then the question is, what is that policy? And as Senator Brown pointed out, actually, much of the policy that this country experienced for over 100 years was actually reinforcing discrimination, reinforcing redlining, or the legal basis of redlining that came from the government, and not addressing issues like the black-white wealth gap and so on. So I know I just broadened it out considerably, but I'm sure you and Paul are totally up for the task. And maybe I can, if I prompt Art enough, he'll find his way back into the list of panelists here and chime in. Thank you, Anna.
Thank you both. And I do think, Erik, we should just have a rule that gives Art, Zoom bombing privileges throughout the whole thing.
Yes.
Featured guests. So not to keep you on camera, sir, but please feel free to chime in. So so you're making it hard, gentlemen, because we all agree, and yet there was this seminal hearing in 2010, 2011, even up through 2013, just taking what Paul said, there was hope for regulating shadow banking, or having some sort of a handle on its boundaries, containing it perhaps. And yet here we are today, kind of tinkering helplessly as we head, over the edge to, again, take what Paul said, if we can't sustain another crisis, then everything that has happened since that wonderful moment of consensus has been kind of underwhelming. Is it just a US problem? Has anyone anywhere done it right? The UK, Europe, has anyone had a more helpful trajectory, more hopeful trajectory than the one that we seem to be traveling along? And Professor Wilmarth, just unmute thyself and, jump in.
I very much appreciate, Paul and Simon, first of all, being here and sharing their time and making me even more embarrassed than I am already. But, I think it's interesting to go back to the immediate post-war period, because I think a lot of my work has been trying to determine what should the regulatory perimeter be, what should government really make sure works well and doesn't go wrong, and then what should government at least try its best to keep its hands off when we talk about financial markets activity. And I think if you go back to the period between, let's say, right around 1970 or 1956, the Bank Holding Company Act, I think, largely got the regulatory perimeter right, because I think they saw that commerce was invading banking and these commercial financial conglomerates were being created, and they were seeing concentrations of power. They were seeing biased lending. Interesting, Paul mentioned the Nazi experience. If you go back to the Bank Holding Company Act debates of 1956 and 1970, they were all about how do we prevent the creation of industrial financial cartels like in Germany, or the Zaibatsu in Japan, which brought us the imperial disasters of 1930s, 1940s in Japan. So they understood very well the confluence, as Paul said, between political, economic, and financial power, and how dangerous it was to put the two together. And it seems to me that there are many reasons why the 50s and 60s were sort of a golden period, and some of those factors are hard to repeat. But this idea that you don't allow banks to sort of get into the capital markets and the general commerce and begin to capture that, or you don't allow particularly large industrial enterprises to capture banks. I think one of the aspects of genius of the American system is the division and separation of powers, the checking of power by power. I think one reason that we didn't have such terrible problems back in the 60s and 70s in the financial system was that the securities firms and insurance companies were checking the banks and vice versa. You had interestingly, sort of a tripartite system, and commerce was completely separate. When you abandon checks and balances and separation of powers and you begin to concentrate power, I'm a great believer of Lord Acton, right? Power corrupts and absolute power corrupts absolutely. And so that's why I fought so hard to try to separate banking from capital markets and banking from commerce. And I also believe that, as human beings, we have bounded rationality. We can only do so much. So I simply don't believe that these large conglomerates that spread over many areas can be properly managed, can be properly regulated, properly controlled. I think GE is just the latest example of that. And so, I agree with Simon. I'm kind of a traditional guy, but I believe that we ought to go back to some traditions that worked. And I think you need a good balance of government oversight, government power, separated and fragmented private power. I like the fact that Senator Brown comes from Senator John Sherman's hometown. And if you go back to the original Sherman Antitrust Act of 1890, the goals of that act were explicitly political. We don't want large trusts, controlling our political system. So it wasn't simply economics. So
this is a great challenge, actually, and I'm really, really glad that you jumped in here, because one way to look for, we can look for comparisons in history. There were periods where this worked, and then we can look for comparisons around the world, right? And the interesting thing to me, and your book is fantastic in this sense, because you're not really limiting it to the US. You have a lot of comparative dimensions there, but the separation of banking and commerce is not the rule everywhere, right? So the question is, how do we get, to borrow from Simon, how do we get from here to there? And has anyone does this right? I mean, maybe starting with Paul and then Simon.
Well, I would say this, wouldn't I? But let me make the assertion and then explain why I think it might be true. I think the UK system is now better than the US system. I think one of the things that's better about the UK system is that the retail banks are ring-fenced within the large groups. You can think of that as a scorched earth policy. Simon was kind enough to mention the kind of international resolution policies that I steered through the FSB. I see John Vickers' ring fencing policy as a backstop if the Tucker policy doesn't work. And I think having a backstop is a good idea. But that's not the whole of it. Actually, the reason the UK system is better is because it has a proper macroprudential authority in the Financial Policy Committee of the Bank of England. And among other things, that body has the responsibility, I know this because I urged the Westminster Parliament to put it there, it has a responsibility to each year advise the Treasury on whether the perimeter of regulation needs to be moved. So it has bolted in to the legislative framework the idea that the perimeter can't necessarily stay in place for all time. Now, why is it better? Of course, it's partly better just because we were a better outfit than the people in Washington. But no, actually, seriously, it was better because the Dodd-Frank Act had to be passed before the midterm elections in 2010. I mean, I'm going to say one brutal thing. One of the things that is delusional about the US debates in this area, actually, this is not true of you three, but it is true of some people that are very close friends of mine, is that the US thinks that it kind of drove the reform agenda and led the way. And it's just not true. Lots of the stuff about big banks was led by Switzerland. And in your own case, one of Dodd-Frank, I'm not going to say which one, said to me while I was going through, Paul, I understand perfectly well, but of course this is basically coming out of G20 policies. That's not just something that we can say. But the important point isn't where the ideas came from, because of course, all good ideas come from all over the place, and so they should. It's that by 2010, all that was on the agenda were the obvious things. More capital, more liquidity, something about central counterparties. The more, if you like, the more refined or ambitious thinking was only then beginning. And the other thing I would say on that, perhaps I'm now getting my points in the wrong order, I should have made this point before. I think it's important for US commentators and analysts not to convince yourselves that things that you've done are the answer to the riddle of the universe. The same goes for other sectors too. Let me give you a concrete example. So a lot of people say, oh, it's really, really important that we did all this swap stuff in the derivatives markets and regulated derivatives. So that all existed in EU law and was applied in the EU for the decade before the crisis. And it didn't make a big difference. I mean, this wasn't a crisis that at its root was caused by lack of regulation in the derivatives market. It was caused by lack of equity in banks. Now, my point isn't, oh, therefore it was a waste of time or a mistake to re-regulate derivatives in that way in America. On the contrary, it wasn't. Those regulations could well prevent other crises. But it's important not to be deluded. Senator Brown said earlier, it's important to tell stories. And actually, it's important for politicians to tell stories. I think it's quite important for leading technocrats not to tell stories because they oversimplify. I mean, I've got friends on both sides of this argument still going on 25 years on as to whether a great sin was committed over derivatives regulation in the mid-1990s. I know all of the actors in that debate, and I think a mistake was made. I do not think that if that mistake had not been made, it would have made any difference at all to whether or not the 2008 crisis occurred. So that it has a kind of prominence in the folklore and is kind of relitigated in a way that distracts from the core issue, which is that it's quite a good idea to have plenty of equity in your core financial institutions.
So Simon, just to also pick up something that I saw in the Q&A, I'm growing a little despondent over here. Canada has very big banks. Europe has long had universal banks. The UK, as we've heard, has its own structures. Maybe then there are a myriad problems and myriad solutions, and we should just take our vitamin and eat our lettuce and pray hard. There isn't the problems of political power and financial instability are not ones that are susceptible, even at the highest level of abstraction, to a single framing or a single sort of menu of solutions. In which case, now what?
Well, I would actually take a different angle on that, Anna, and say, instead of thinking of lots of different countries having lots of different policies, I go back to this, let's call it Tucker 1 view, the global resolution version of Paul's work, and say, actually, guys, it's one big problem. Because if this piece falls over here, this other piece falls over here. And I think what was very clear from Paul's practical work and arts, academic work and so on, is that the shadows that link these things across borders are in some ways the most insidious pieces, Anna. And it is fascinating. And I completely agree with Paul 2 or Paul 3, whatever, that just emphasize it's the equity, stupid. Right. I think we have made tremendous progress on the rhetoric and on the practicalities of policy across many countries. We have not yet persuaded the editors of the Wall Street Journal to stop using the verb hold when it comes to bank capital. But I spent about 5 years trying to do that, by the way, and it is impossible. They cannot understand. Well, sorry. The journalists of the Wall Street Journal and many other places, not to pick on them, but this is where I had some interactions. So it's firsthand. They understand full well that equity is a question of how you finance your positions, and they understand that getting over leveraged is not only a bug that appears in the financial system. Actually, it's seen as a feature by many people because you get paid based on the upside returns, and when it's the downside, you can push that off on someone else through various mechanisms. And if you're too big to fail, even better. But there's other ways to do that too. And yet, Anna, we have not persuaded and I think this is a failure of all of us, honestly. And I think it's a failure in our classrooms. It's a failure with our students. It's going to take generations to shift people away from the idea that somehow I'm holding equity instead of holding some other asset, versus funding myself with equity. More equity. I should fund myself with more equity relative to the debt. And thank you, Anna Admatu, I'm sure is out there somewhere, for hammering this. It only took her like 3 months to hammer this fully into my brain, but it was about 10 years ago. So I take credit for listening to Anna early, and of course Martin Helwig and their great work.
Let me add one point I would like Paul's view on, because in some ways I go back to the British banking system, before the 1980s, where the wholesale capital markets, were, as I understand it, primarily in the clearing banks. And my proposal is that if you're going to issue a debt instrument that's payable at par with a tenor of less than 91 days, that has to be in a bank. Because if we have all the short-term money in the banks, we know where it is, the regulators can see it. Actually, reserve requirements would become effective again if only banks could hold short-term money. I mean, Paul, do you think it's possible? I mean, and do you think it would be a good thing to say, and I think it's also becoming salient because if you think of banks as the center of the payment system, I think it's really important that all the short-term money be in banks and that the banks be the center of the payment system. And with that, as I hope, significant
So basically, I agree. And over the next few weeks, maybe a month or so, a paper will be published on this with co-authors probably. I'd start one step back. I think there is something very special about instruments, assets that people regard as safe. Safe in the sense described by Bengt Holmstrom, the MIT Nobel Prize winner, which is that they are informationally insensitive. We hold them and we trade them and we invest them, etc., on the basis that we really don't need to think at all about what lies behind them. So money is the canonical safe asset, but loads of other things. Treasury bond repo is treated as safe. And the key thing about instruments that are treated as safe is that they're going to need to be safe under stress. Otherwise, you get circumstances where suddenly something happens and people say, oh my goodness, it might not be safe. And the market ends and there is panic, which is essentially what happened in the middle of 2007 in anything concerned with the asset-backed securities market or the subprime market, including in repo markets. And so what I would say, I mean, I've set some of this out in public already a couple of years ago in a lecture at the BIS. I would say that anybody who issues liabilities that are treated as safe must have access to the central bank's discount window and must cover 100% of those short-term liabilities, those liquid safe liabilities, with assets at their discounted value. The haircuts, by the way, of the central bank would then drive the the equity requirements that we were talking about. But you can apply this to money funds as well. Steve Caccetti and I have an idea on this that we're going to write up. You can actually apply it to everything. And then what you're left with is, once you've done that, which is kind of variant, it's kind of in the family of things that Art talks about. Once you've done that, you then need to ensure that nobody outside that ring markets anything else as being safe, and that the accountants don't allow it to be treated as safe. Because what is treated as safe is a kind of social practice. It isn't something which, if we four were the governors of the Federal Reserve, we could deem to be true. It's what do you do when society starts behaving as though something's safe and it actually doesn't have access to the window or whatever, because you know that when it becomes big enough, they will get access ex post, both to the window and, so I think actually, so I think one can take Art's basic thought and say, yeah, this is completely right. And what does a general policy for that look like? The thing that I kind of schizophrenically both promoted and resisted when I was in office, something had to be done about money market funds, but all in the short run, but all it did was push the action elsewhere. And the problem with waiting until something's got really big is that in your country especially, by the time a market or a set of intermediaries activities is sufficiently big that it's obviously systemic, it then has the lobbying power to stop anything being done about it. So, which is actually the best case, a kind of follow the problem strategy is not going to work for deep political economy reasons, which is frankly the role of money in your politics. And so one needs a general policy.
So I'm thinking,
can we pull back? Simon, if I could just make sure that we address this one element of the argument that I think we've been sort of dancing around. There is the regulating activities model, which seems to have gotten ascendant in recent years, and then it's somehow seen as distinct from and perhaps even mutually exclusive of the institutional and structural reforms of the sort that we've talked about as well, right? So if the problem is bigness, if a problem is bigness, right, one way to deal with it is, and as you said more than a decade ago, break them up, right? Or tax them. If we are chasing assets that are treated as safe, either because they're implicitly backed by the state or for other reasons, and maybe this is where macroprudential comes in, well, then maybe we have a somewhat different approach. I mean, I've certainly been on the record that it should be all of the above, but how do we think about structural separation, size, and then just risky activities, risky assets?
Well, I think we read Art's book, Anna, and it's all in there, as I understand it right now. It's sort of the Art Wilmarth 2010 meets Morgan Ricks 2015. I was going to say, this is just like one of these movies where you want to say, you say, well, now I'm going to turn to Morgan Ricks, and he popped up on my screen. And I said, you know, I really want Peter Conti Brown to come in and talk about the political economy of bank regulation. I see he's up next too with Kate Judge. So you've got a great agenda here, Anna. I would just say, you know, and I think Paul said this, Paul probably said everything. Okay, so let's be clear. And I'm just standing on his shoulders as well as Art's. It's necessary but not sufficient, Anna. So belt and suspenders, you want it all, multiple fail safes. You know, why do banks fail, Anna? Because all things fail. I think that was Voltaire before Paul Tucker, but I'm sure Paul said something about that too. Anyway, so the multiple fail safes, simplify it. But again, Anna, back to the primary question here, okay? What is the problem we're trying to solve? So if we put these safeguards in, if we prevent the people who want to play casino massively leveraged, we prevent them or lower the probability that they blow things up. Have we solved the fundamental problem that Sherrod Brown put to us less than an hour ago, which is jobs? We want more good jobs in more places, right? Do we have a financial system, Anna, even if we make this system safer, we put the safeguards in, do we have a financial system that won't discriminate? Do we have a financial system that is going to be inclusive? Do we lower the cost of being poor, Anna, in the United States and other places? Part of the high cost of being poor is because the financial system is really expensive to interact with if you're poor. I'm not sure.
I think
we have
the
more
next art
capital.
book. Okay, this is Wilmarth's the next art book. So we're going to keep him going. Come back in 5 years. But I think Art, I think where we've grappled with financial stability productively and made some progress, we'll find out how much progress. Lev Menand's work, if you haven't read it, guys, on what happened in 2020 and the role of shadow banks and the role of the safe assets, exactly in this Tucker context of, oh my God, it's treasury repo may not be so safe. That market may break. I think those are really interesting salutary lessons that have not yet been taken fully on board. But I think, Art, for looking forward, the next question I'd put to you is, what's the better financial system that we can design? Because that design matters, and your thoughts on that, we want to hear your thoughts on that. And I'm very interested in having the market be a more important part of that. But I think the market has failed us dramatically, repeatedly, and over more than 100 years on multiple fronts. So let's go back to the drawing board a little bit.
And let's have a different conversation 5 years from now. I mean, it does sound a little Groundhog Day, right? So, you know, more capital, it's fantastic. Does that get you more jobs? Structural separation. Again, how do we, if formulating the problem the way you have, how do we get from here to there? And Paul, you don't have to answer, but
well, I think there's a real risk here. So I completely agree with the chair, the social goals that Senator Brown and Simon are articulating. But we've got to hold them separate from ensuring that the financial system is stable. If we have another financial crisis, that will completely derail campaigns on social justice. So I regard myself as having, if you like, the thing that connects the two parts of my professional life when I was in office and since, is I think I'm in the business of trying to persuade people to have solid foundations pursuing their conceptions of social justice. And that if we have financial crisis, I think social justice is one of the things that almost always gets discarded. Not absolutely always, but almost always. And so on these questions of excessive corporate power, and actually there are four things: decent services to consumers and social justice and a stable financial system. I think it's quite important to recognize the links, for sure, but not think that addressing just two of them means you can ignore the other two. It doesn't. I mean, the idea of having a good constitution for a stable financial system and then being too tired to do anything about social justice is a disgrace. But on the other hand, focusing on the quality of services to consumers and on social justice won't get very far if there is another financial crisis over the next 5-10 years, which would be good for nobody other than the denizens of Beijing.
Speaking of the denizens of Beijing, maybe this is a nice titillating point to end on, because we're coming close to our to the witching hour here. The competition has been framed very much in transatlantic terms for decades, right? So the story has been, you know, we can't have more capital because, God forbid, you know, Europe will have more capital. I mean, less capital and they'll eat our lunch. You know, all of the conglomerate supervision issues that were salient in, you know, sort of the early aughts and led to more deregulation rather than more consolidated supervision. Well, today's political headline is competition with China, whether you buy into it or not. This is a rather different financial system, a rather different set of social, political, and economic goals, and a rather different sort of handle on financial stability. Maybe Simon, does this context make the problem any different, and tell us anything different about the solutions we should be pursuing?
No, I don't think it does, Anna. I mean, I think to Paul's point, financial stability can destroy everything. And so that should be, you should take that as a paramount priority. And I don't see, I mean, I think a very big mistake, Anna, was to take seriously these arguments that somehow the Europeans were doing something better or different. And that required us to for example, increase the allowed leverage in our banks. Thank goodness Sheila Bair and the FDIC dug their heels in right in 2007. If they hadn't, then I think we would have been in much worse shape in that crisis. So I think, you know, if other people want to run their banking systems undercapitalized, I would stand well back. Okay, in all economic and political senses, and in terms of the social justice, I mean, Paul is right that these two things should be seen as separate goals, and separate goals require separate instruments. That's absolutely right too. I don't, and we should worry. We should worry a great deal, Anna, about trade and about competition and about the impact on the middle class. I think David Autor and his colleagues' work has made that point rather dramatically. I think that's the big rethink in economics over the past 2 decades. Financial stability, we've rethought to some degree, but that should have been more obvious earlier, and it was obvious to Art and Paul earlier, maybe some of the rest of us to catch up. But rethinking trade, Anna, and the impact of China on global trade and on jobs, and how that feeds through to social justice, that's really important. And I don't think we should, on the social justice front, try to think that finance is something very different from what's happening in the real economy, because it's not. It needs to be more supportive, it needs to be more responsible, it needs to be more inclusive, you need to reduce the costs of relatively poor people, and you need to not blow up the financial system. Well, I think, you know, we can walk and chew gum at the same time, Anna, but don't get distracted. Please, no one get distracted by what China's doing or what some European country does, or whatever else happens around the world. You know, we do this for the United States, we do it for the world's largest financial market. And then if we could get a better grip on these issues and at least stay ahead of them to some degree, I think we'll do ourselves and the world a great service.
Thank you very much.
Well, I need to break in as our conference organizer and keep us relatively on track. I could listen to the 3 of you and Art all day. Thank you, Simon. Thank you, Paul. And thank you, Anna, for a very great fireside chat and discussion. And my
Let's just say amen, and it's all in Art's book.
Congratulations, Art.
Thank you.
This is the downside of having all-star cast throughout the day, is that we have so many people to listen to. I will now introduce our next panel, our next group of all-stars. First, Kate Judge is the Harvey Goldschmidt Professor of Law at Columbia Law School. Second, we have Nadav Orian here, who is an associate professor here at the University of Colorado Law School. Let me put a plug in. He's a rising star in our field and one of our truly great recent hires here at Colorado. Third, we have Morgan Ricks, who is a professor of law, the 2020 Chancellor Faculty Fellow and Enterprise Scholar at Vanderbilt University Law School. He is also the author of The Money Problem, which Simon mentioned in the previous panel, and I highly recommend. And our moderator and panelist is Peter Conti-Brown, who is an assistant professor at the Wharton School of the University of Pennsylvania, and a non-resident fellow in economic studies at the Brookings Institution, where he is affiliated with the Hutchins Center for Fiscal and Monetary Policy and the Center on Regulation and Markets. So let me turn it over to Peter. Thank you all for joining us.
Thanks so much, Erik, for putting this together. And with Erik's approval and encouragement, I wanted to begin by saying a note of special thanks to the man of the hour, Art Wilmarth, whose intellectual output and contributions are the subject of all of our panels, but perhaps not as widely known in his public persona, is just what an incredible mentor Art has been to generations of scholars who have joined him in the study of banking and financial regulation. A little over a decade ago, I was a fellow at Stanford, recent graduate of law school, trying to find my way, writing what I look at back with some wincing as mostly mediocre law review articles. And I found that joining the academy was a bit, there were some sharp elbows among our colleagues, and people who had been in the field for a while were pretty eager for new folks to make sure that the attributions were appropriate and that we were able to point to them for their pioneering efforts. And ironically, Art, the greatest pioneer and pathbreaker of them all, was the opposite of this. I remember one article that I wrote that was okay, and he made me feel like it was just A+, gold-plated, and encouraged me in that process. He could have so easily snuffed out a lot of candles because he'd been on the beat for decades. And he was the opposite of that. He was the man with the flamethrower. If you had even just a little bit of an idea, his intellectual caliber could bring that and turn it into something great. And I know that I speak on behalf of so many of our colleagues who joined the field following him, whose work he made better, even and perhaps especially when we disagreed with him. So today, with our all-star cast of panelists, we are going to agree and disagree with the great Art Wilmarth on the role of central banks and financial conglomerates as they work together, sometimes at odds, in creating the infrastructure and architecture of monetary policy, payments, and financial regulation. We're going to start, I'm going to open a question. We'll go in order on my screen, which is Morgan, Kate, and then Nadav. And with the same question, we have just gone through a period of time, second perhaps only to the 2008 crisis, that has focused the attention of the world on our field of study, and in particular, the subject of this panel, which is central banks and financial conglomerates. Drawing on your own work and the work of our great friend and mentor, Art Wilmarth, what do you make of this year that we've just survived? What did 2020 do to teach you things you didn't know before, to question things you thought you knew? But also, what does it highlight in your work that preceded it, or in Art's work, that you think, in fact, deserves more attention than it received? And feel free to riff on that theme wherever you'd like to go. Well, I'll take just a few minutes for each of you, and I'll cue you so as we transition. So Morgan, you're up.
Thank you, Peter, and thanks to Erik for organizing this great event. And I could have listened for hours to all our preceding speakers, both the senator and Mark and Art and Simon and Paul. It's really been wonderful and worthwhile already. So I'll just start with a personal note about sort of what I've learned that connects to Art and his work, is that, for a long time, I didn't think affiliations really mattered that much. And I thought it was a secondary issue. And even when I wrote my book, this is my biggest regret in my own work, is that I think I even in the book said I was agnostic affiliations and affiliations between banks and non-bank financial firms, dealer firms specifically. And I think I was wrong. I think Art has been right about this all along. I think he's been a bit lonely on this, but we now have, and it's become clear in the last year, a monetary financial complex of vast proportions. I use that term, which is the title of a forthcoming piece I'm writing with Levman and what we have is a situation in which our largest financial firms are operating essentially parasitic on the central bank with a robust backstop. And it's not a good situation. It leads to rent extraction. We're seeing exorbitant profits in our largest financial firms. It also applies to hedge funds, which essentially rent our largest financial firms, our dealer firms' balance sheets. And the Fed is at the mercy of the funding markets, in particular the repo markets. And by the way, the repo disruption started before 2020. They started back in September of 2019 with the Fed lending over $250 billion to dealer firms. At that point, the Fed doesn't have a choice but to backstop these markets. It leads to rent extraction. It leads to pumping up of asset prices. And I think we're seeing that right now. We're seeing asset prices that are shocking. It's going to be very hard for the next generation to afford buying a house, and they're going to be investing their savings at sky-high valuations because we are pushing up. We have a system that's pushing up asset prices, and it's a recipe for instability, right? The Fed didn't have any choice but to roll out its entire panoply of liquidity support essentially on a dime last September, and we have a liquidity put to the central bank of proportions that we didn't even fully comprehend back in 2008. So I think what I've learned is that the problem is still with us. We haven't solved the problem. FSOC was not a solution, neither were designations, and that Art has been correct all along. I wish I could rewrite my book and say a bit more about affiliations.
Great, thanks, Morgan. Kate?
So much to say. So I guess I would start with somewhat where Morgan started, which is that we've learned that the resilience of the financial system is critically important to the health of the real economy. That happens either because of problems that emanate in that system and spill over the real economy, or a shock to public health that affects the real economy that then either is going to be magnified or muted by the health of the financial system. And I think, like Morgan, one of the big lessons from 2020 is we do not yet have all the infrastructure in place that we need to promote an adequately resilient system. And I think we got very, very fortunate because we acted very aggressively. The Fed acted aggressively. Congress also acted aggressively. I think another lesson of 2020 is that when you pump a lot of money into the real economy, that can be an indirect way of helping to stabilize the financial system with perhaps fewer equitable concerns. But that is not the only thing that happened. But I think was one of the mechanisms that helped us get through that period. I also want to connect the challenge that you framed to Art's work. So like others, I could not be more grateful for Art as a figure, as a mentor. I remember after I got tenure, there was like a small handful of senior scholars that I just really wanted to reach out to immediately. And Art was one of those, and we sat down again after that because I was trying to figure out where to go next. And I think a lot of what I've learned from him comes not just in his insightful conclusions about what we ought to do, but how he gets to those conclusions. There was a long period of time where I think methodologically, a lot of legal academia was very critical of the approach that Art took that actually Senator Brown was heralding, which is sometimes referred to as thick descriptive. I think about Art's piece on Citigroup, and it was just a remarkable piece of let's look at every aspect of the stories they told and then what subsequently happened and look at the gap between those two. But I think that's actually very often what you need to be able to understand kind of what are the ripple effects. We're focusing on this particular area, this particular policy question, but what are the many ripple effects that flow from how we go about trying to address that? And so I think part of what we're gonna have to do when we're studying 2020, when we're looking forward about what it is we want to achieve, is to embrace a little bit of that methodological approach of let's actually start by just understanding what goes on. And I think just as importantly, where does power actually lie? And I think putting those issues at center stage of the conversation, in and of itself shifted the conversation in ways that are going to be critical for a long time to come.
Wonderful. Thanks, Kate. Nadav.
Yeah, also joining how nice it is to celebrate art, and so many thanks to Erik for putting it together. So I think what is so striking about 2020, and this came out really nicely from the conversation between Jeremy and Mark this morning, Morgan's comments. I think that 2020 is really a stress test for the post-crisis architecture. And I think it's fascinating to see that from the point of view of the Fed, this is largely a success. The architecture is considered to be a success. And I think it's really interesting to kind of critically reflect on it, in the spirit of art's work, both the successes and the failures. So I think what it brings out for me, first of all, with respect to art, if we think about the landscape of money creation, right, there are basically three categories. So there's banking, which is deep within the regulatory parameter. There's broker-dealer intermediation through repo, et cetera. And there are things that are even more on the vanguard, in the sense that the points of regulatory entry are even fewer and less robust. And I think that what 2020 shows about the last decade is really the way in which affiliation, right? So the theme that Morgan opened with, and that is so central to art's work. I think that affiliations have been a really, really, really central way in which the Fed extended its regulatory parameter in order to basically take a position on broker-dealer intermediation. And this is very understandable in light of 2008, where we had the big five independent broker-dealers who were not subject to Fed consolidated supervision, precisely because they were not financial conglomerates. And I think what we're seeing is it's almost like an art in reverse, right? Where the financial conglomerate that art considers to be so incredibly problematic for multiple important reasons that he raises, under the current system that we inhabit, that is precisely the entry point for the Fed to take a regulatory stance on the repo market, right? So on broker-dealer intermediation, on broker-dealer financing of their own inventories of broker-dealer matched book operations and funding of hedge funds, with the hope that maybe by controlling this really, really central node, the Fed would also be able to gain some influence downstream. So over hedge funds, et cetera, that are repo borrowers. So I guess for the first part is I'd just like to highlight that, that flipped art sense, in which almost all of the successes of the post-crisis regulatory agenda, the supplementary leverage ratio, the liquidity coverage ratio, now the net stable funding ratio, their extension to broker dealers, all of these things which are celebrated as successes have come at the price of basically blessing the financial conglomerate form and working through it.
Great, excellent, terrific points. One of the great strengths of Art's oeuvre is his focus on political economy, the political channels through which financial regulation and financial legislation is created. And Art, like so many folks in the discourse today, but preceding them by many years, felt profoundly uncomfortable, of course, with size and concentration and conglomeration across the lines that we've already talked about, but just even their sheer existence as an existential matter. Financial concentration presents harm not only to stability, but to political hygiene and political economy. So in the best tradition of Art Wilmarth, I want to put a little bit of pressure on those thoughts and wonder if you'll engage with me on these in that dialogue. Our colleagues, Jeremy Kress and Matthew Turk, have written an excellent article that is I would call it kind of on the fetishization of community banks, and is small really so good? Again, not thinking about a financial stability and systemic risk perspective, but purely on political economy. And we heard a little bit of this even from Senator Brown today. Is Art wrong to be much more enthusiastic about the political economy channels through which community banks operate? Or is that creating a different kind of political pathology that might have risks that could be pretty harmful too? And as evidence of that, we think historically, history of the United States, be it from a perspective of financial inclusion, be it on intermediation and pushing the channels of intermediation broadly through society, that history is not good. It's actually quite dark, and it's a history dominated by community banks until recently. So let's go in the same order. Morgan, what are your thoughts on this? Should we give community banks less due, or is Art hit that target right in the bullseye?
Well, it's a great question. I mean, I think there's a great deal of distance between a $4 trillion mega bank and a community bank, and large regional banks are also a different model, and we shouldn't exclude them and think of this as just being polar between the very largest and the very smallest. And I do think there are political economy problems on both extremes of the spectrum, and I don't think anyone really wants to return to the unit banking world that we used to have. And by the same token, that doesn't mean that concentration ad infinitum is just fine from a political economy standpoint. So I think there's a degree of fragmentation that may be optimal. I think it's difficult to know exactly what that degree is, but I'm not willing to say because the history and experience of community banking has not always been optimal from a political economy standpoint, that means we should be sanguine about the mega bank problem.
Kate.
I think I agree with Morgan, and I would even go one step further. I mean, I think at this point, actually, within a lot of the progressives and broader Democratic circles, there's very mixed views of community banks. And I'm right in the core of thinking that I'm actually a complete fan of community banks. And I think this past year really helped to show why. I mean, we look at something like PPP, and that was an effort by Congress to say we want to help small businesses, but it was entirely reliant on the mechanism of the intermediation system in place to make that happen. And I think small banks and community banks really stepped up in a way that large banks didn't. I think if we look at the overall composition of the portfolios of the two different types of banks right now, community banks have been much more active lenders. And again, this is a period of time where the type of people who need access to credit really need that access. So it is smaller businesses. It is oftentimes the individuals who are not necessarily the most creditworthy. And so I do think that there's trade-offs in any system. I do think given the history that we, I think, need to be attuned to, we need to be thinking about what more we can do to make sure that they are serving community in a very broad sense, and that within the network of what we have as community banks, there are community banks that are really committed to serving all different segments of the population. So I think there's a significant room for growth and improvement, but I think there's a lot to be said for making sure that we do continue to have a healthy community bank sector.
Great. Nadav.
Yeah, I think it's a fascinating question. I mean, one observation which is historical, just from turn of the 19th century US banking, is that when we think of unit banking, a lot of times we have really romanticized, visions of small independent entities. In fact, the centrality of capital markets in the US financial system historically, so dating 100, 150 years, had so much to do with the unit banking system. Because what does unit banking create? It creates very large clearing flows that have to be managed by small units. And the classical way to do this is by holding money market claims in order to meet those clearing constraints. So classical work of Margaret Mayers in the 1930s, et cetera. The call loan market which is a predecessor of the current day's repo market, was very much a creature of the unit banking system. That's a legacy we still inhabit today. Second point, I think the advantages are, as Kate mentioned, are really how do we think of the composition of the asset side, and do we like it better? And here I would go even further than community banks, community development financial institutions. Right? These are the institutions that are doing the most important and difficult type of lending. And here's kind of like Morgan in reverse. These are almost the only financial institutions, the only important subset of financial institutions that do not have access to issuing the money supply. So CDFIs are radically under leveraged from the point of view of commercial banks. They don't fund through deposits. They fund through a combination of donations and very scarce debt. And then just last point quickly, I saw an interesting comment by Jeff, whether the point about holding companies was the anti-art in the sense, in some normative sense, that it's a good thing that the Fed is using its consolidated supervision powers over broker-dealers to extend its regulatory reach. I don't know. I intended it more descriptively. I think there are very strong normative points on Art's side here, and I think they're real sacrifices. It has some degree of success that Mark highlighted, and it has some really troubling aspects as well that Morgan highlighted. And what we're seeing today is just a huge amount of pressure on money markets to immigrate outside of broker-dealers' balance sheets. And the lack of structural separation, the lack of structural solutions, sponsored repo, collateral swaps, these are all things that can happen outside of the dealer's balance sheet. And I think that is really, so 2020 shows us some cost that was already realized that Morgan highlighted, and there's also a cost that remains to be realized with these new institutional developments.
Great, thanks, Nadav. We have just 3 minutes left, and there are so many questions left unanswered. Principally, is Art Wilmarth a socialist, Republican turned socialist? Others are, what would Art Wilmarth say about central bank digital currency? But let me conclude with a methodological question that Kate touched on a little bit earlier. Art is a constitutional lawyer, did really important work on preemption in the banking context. He's a historian, and he's a theorist. He has facility with legal doctrine, but he's also really looking at some big public policy questions. So let me just ask you to reflect briefly in the couple of minutes we have left in the same order. What do you learn from Art Wilmarth, the methodologist, and how does that shape who you are and how you see the work that you do in the debates in which you're intervening?
That's another great question. I think it's legal scholarship at its best. This is what we can offer. Above all else is institutional knowledge, detailed institutional knowledge, and its history, and its implications. And that requires history. It requires theory. It requires empirics, maybe not always formal empirics, but an understanding of what's been happening and what is happening in the world and the structures that surround us. And I think Art really exemplifies what it is we can do if we want to make a difference. I think Senator Brown's comments about Art's work influencing him are a prime example of how important it is and how impactful it can be to pursue legal methodology of the type that Art has done in his scholarship.
Great, Kate.
I would agree with everything Morgan just said, and I did chime in on this earlier because I think it is so central. The one thing I would add is I do think that there still is a tendency within the legal academia environment to put public law on one side, private law on the other, and somehow anything with numbers ends up more in the private law arena. And I think the way you were framing his trajectory as a scholar is a beautiful reminder that actually we really, really need to understand banking law as part of public law. in terms of the institution accountability issues, in terms of understanding kind of where power actually lies, the political economy dynamics and the interactions between kind of legitimacy and where power lies, and the public and private interactions are at stake. So I think along with is let's look really closely at what's actually going on, which I think remains critical, is also making sure that we understand that this should be on the public law side if there has to be sides of the ledger.
Great, Nadav.
Yeah, so endorse everything Kate and Morgan said. I think the only thing I'd add to that is I think you know, when I was first studying financial regulation, there was so much excitement about the various technical aspects of Dodd-Frank and Basel III, et cetera, et cetera. And I think that to me, Art stands first and foremost as somebody who, you know, well, it's important to have a deep understanding of all of these aspects. It's critical. Has always also stood for the kind of the architectural view, right? So supplementing, basically supplementing the forest for the trees, and that's an instinct that I'm really grateful for.
Let me thank my excellent co-panelists and Art. We love you. We're inspired by you, and can't wait to read the next 5 books that you've got waiting on your hard drive.
Thank you, Peter.
Please join me in thanking a great panel: Kate Judge, Morgan Ricks, Nadav Orian Peer, and Peter Conchi Brown. The wonderful thing about organizing this conference is you get to invite a lot of your favorite scholars and friends. The downside is there's just so many people to hear from in a one-day conference. We're going to turn now to our next panel, which talks about fintechs and the separation of banking and commerce. We are joined by an all-star cast, each of whom has deep expertise in fintechs and banking law. First, Hillary Allen, who is associate professor at American University Washington College of Law, who is currently writing a book on fintech and systemic risk. Next, Kristen Johnson, who is the Asa Griggs Candler Professor of Law at Emory University School of Law. Third, Rory Van Loo, Associate Professor of Law and Peter Paul Career Development Professor at Boston University School of Law. And fourth, and last but not least, our moderator, Saleh Omarova, my good friend, who is Beth and Mark Goldberg Professor of Law at Cornell Law School. So I will now turn it over to Saleh.
Thank you so much, Erik. And let me just start by saying what an incredible privilege it is to be here today, celebrating Art's wonderful book, his wonderful career. Art has been a tremendous mentor to all of us really here, stars or no stars, right? And I personally remember that Art was literally the first big name academic to whom I went with my little write-up of a proposal for a little paper about banks' derivatives powers back when I was still at the Treasury. So thank you, Art, for everything that you've done for me, for all of us. So with that, we're going to turn to a broader issue that Art's scholarship really puts on the table for us, right? So Art's focus has always been on structural regulation, structural reform, and affiliations within big financial conglomerates among banks and non-banking financial institutions. But of course, it's part of a bigger conversation that cannot be avoided, especially in light of the existing bank holding company regulation and after 1999, after the Gramm-Leach-Bliley Act's enactment in particular. And that is the issue about the separation of banking from commerce in the United States and what the reality of the matter really is vis-a-vis the pretense or the beliefs in the law, right? It's a very controversial and complicated topic because we still really haven't figured out how to navigate that line between banking on the one hand and, for example, securities capital markets, derivatives business on the other. And now we have to deal with broader issues. What about technology? What about products that are very difficult to place, right? Either in the financial world, strictly speaking, or in the technology world, strictly speaking. So what do we do with that? And here it's kind of important to place everything in the larger context of the controversy around the very concept of separating banking from commerce. As we all know, that principle is not a universal principle around the world. It's very much a US, a very historically driven development in its time. And we have it kind of embodied in a variety of statutes and a variety of regulatory issues pursuant to those statutes. We have part of it in the National Banking Act, but most of that principle works through the Bank Holding Company Act, right? So the traditional case for having the separation of banking and commerce rests on a few public policy considerations. For example, we need to protect the banking system from a variety of risks that are associated with commercial activities outside the banking perimeter per se, with which the bank regulators, for example, are not sure how to deal, right? Another big issue is avoiding conflicts of interest, because banks are traditionally the primary channels for allocation of credit, and we want that allocation of credit to the real economy to be efficient and fair. And so if we allow those banks to be affiliated, for example, with commercial enterprise, how can we prevent the unfair self-interested types of allocation of credit, for example, to one's own affiliates and so on and so forth? Yes, we do know there are certain provisions in the Federal Reserve Act that sort of tend to limit that kind of credit subsidy leakage, but we also know that it doesn't work very well in practice. And finally, there is a bigger concern with excessive concentration of economic and political power. So there are interesting unresolved issues, however, conceptually in that debate. And in my view, that's probably the next step in the debate with respect to, how do we preserve the stability of the banking system per se? How do we deal with affiliations between banks and securities firms and other financial firms? The next step is how do we prevent affiliation of those financial conglomerates with non-financial companies? And it sort of raises these issues because this is a two-way street, right? One way to look at this principle is how do we and should we prevent, for example, banking institutions from entering into commercial sphere, right? Basically starting to offer commercial services, commercial goods, and commercial products. What are problems with that? Should we allow JP Morgan, for example, to become a provider of purely technical or technological products, for instance, right? But the other way is, what should we do when non-banking, non-financial companies like Amazon, like Facebook, or startups from Silicon Valley are beginning to offer financial services and banking services? Where's the line there? And what are the issues? What are the problems that we have to deal with in that respect? And perhaps the policy concerns and legal issues are the same. Perhaps they're different. And this is why we're so lucky to have Rory, Hillary, and Kristen to talk us through some of the issues that they see in that respect. So for the first round of questions, let me ask you first two questions, each one of you. I would like you to share with us your thoughts as to what you see as potential benefits of perhaps removing that wall between banking and commerce in light of the new technological developments and all of these exciting progresses and advances that we're seeing around, right? So what are the potential benefits? The reverse of that question is, what do you see as the potential danger of allowing that to happen? So each one of you has written extensively in specific areas that kind of pertains to that. So if we could go in order, let's start with Hillary, then go to Rory, and then to Kristen, answer those two questions, and then I ask you a second round if we have time. Hillary, please.
Great, thank you, Saleh. And I'm just going to have to quickly thank Art, as everyone has on this panel. When I came into the Academy 10 years ago, I came in in a non-traditional way. I had some ideas, but I had no idea what I was doing. And just having support from Art very early on was it just made a world of difference to making me feel like I actually belonged here. So I'm incredibly grateful to Art for his mentorship, as well as for the legal foundations of his work, which we are building on today. So, a bit like Art, I'm a little bit of a pessimist on all this stuff. So, you know, I have not drunk the fintech Kool-Aid. I don't see a whole ton of benefits necessarily in breaking down this separation between banking and commerce here. But I think it's important to be precise about what we're talking about here. As Solly already alluded to, you know, the actual legal separation that we have between banking and commerce is not as robust as people think, and it's jurisdictionally based. It's primarily focused in the United States. And really, you know, what it does is it doesn't prevent firms from offering financial services. It prevents deposit-taking firms from entering into other commercial areas. So you can provide financial services, you know, of a payments type or a lending type and not be brought into this. And so I actually think the debate is bigger than the separation of banking and commerce. It's the separation of finance and commerce. There isn't really a legal separation there. I think the rise of Amazon, Google, you know, Facebook wanting to get into financial services. They have, you know, they have their lobbying group, Financial Innovation Now, about trying to get into financial services. I think Alibaba's, you know, success with Alipay in China is just too appealing an example not to try and follow. We've already seen Facebook try and bust in with Libra. So, I mean, I think this is coming, and I think it's a really huge issue. And I don't think you can address it simply with the legal separation of banking and commerce we already have. In many respects, I think this is going to be more of an antitrust issue than something that can be solved by a financial separation of banking and commerce. And I think there's, to go slightly off topic, I think there's also an interesting question about whether financial regulation can help with the antitrust problem. For example, could something like SIFI designation be used as a way to keep from Amazon, Google, et cetera, from becoming even more big and powerful? I think that there's an interesting question there, but that's off topic. So that is a long way of saying that I'm very worried about the too big to fail aspects of these institutions coming into finance, notwithstanding that they won't necessarily take deposits. You know, there'll be a question about whether the e-wallets that you use to hold your whatever the payment stuff is that these firms provide, will that be a deposit or not? That will be a legal issue, but I'm sure there'll be ways of structuring around that. And I think they will probably eschew deposit taking per se. And so then they avoid a lot of the rules. But that doesn't mean that we necessarily can feel comfortable, because notwithstanding that we won't have the traditional maturity mismatch between deposit taking and other activities, there are plenty of other sort of financial stability concerns to be, to be wary of. For example, there's infrastructural concerns. These firms already provide all the cloud infrastructure that we rely on. If they start providing payments infrastructure as well, if that goes down, what's the harm for the broader economy there? I think there is the potential for runs in the Libra proposal from Facebook. That's a moving target. They keep, revising it, but I still think there's, a perspective for runs there. I think even if there isn't a risk of insolvency from a run-like dynamic, merely pulling out of a market because it stops being, a profitable thing to do, if there are no substitutes, that can be a problem. So if we're really, and this goes back to the framing earlier today, if we're really concerned about financial stability because of the broader economy, right? Because of the broader economic growth, because of the fact that we need that stable economy to perpetuate democracy, I think we need to get out of that sort of very narrow framing of runs on deposits as being the only thing we're worried about. So I think the separation of banking and commerce that we have now is not really up to the task of what we're worried about, but the broader normative conversation about the separation between finance and commerce is only just beginning and is going to be, I think, one of the crucial ones as we go forward.
Well, thank you, Hillary. It was not off topic, by the way, for you to talk about the potential solutions, because that will be in the second round of my questions. So hold that thought, and I will specifically grill you on particular proposals. So Rory, the stage is yours.
Great, yeah, thanks. And like others, I just wanted to start with a quick anecdote. So when I entered the academy, I remember meeting early on with Pat McCoy and asked her, I said, basically, I have no idea. I don't know anybody. And who are the people that I should get to know? And I said, I don't really care if they're a big deal as much. I would like to know the people that are, kind and the types of people I'd want to have as colleagues. And one of the first names that came out of her mouth was Arts. And she said, but he's also a big deal. And he's also really smart, but you'll never know it. He's just so kind and generous. Anyhow, so I'm delighted to be a part of this as everybody else is. To answer your questions, which are terrific. And thanks so much, Sally, for kind of being so thoughtful about organizing this panel and framing it. So when, I'm not here to kind of speak against bringing Glass-Steagall back or anything like that. But the main point that I want to make is that there's at least some versions of the path forward would be in tension with something that doesn't get enough attention in financial regulation, and that's competition policy. And I'm not talking about competition policy as it's been mentioned earlier in terms of how competitive are we with China, or in the sense that it's usually used, like where industry argues that we need to deregulate for competition. I'm talking about from more of a consumer welfare lens, if you will. I get that stability needs to take priority and that as a result, competition needs to take a back seat. But that doesn't mean that we need to leave it on the side of the road as it tends to be handled. So a quick example of the dysfunction. So when fintechs were just arriving on the scene, they were becoming a concern to banks and had really the potential to kind of take the industry by storm. Tom Curry, who was then the head of the OCC, he issued a statement to the staff about how to handle this rising development. And what he said is he wanted them to think about how we can act as a bridge between traditional banks and fintechs, or as a clearinghouse for information to both banks that are interested in expanding their reach through technology, or potentially entering into partnerships with technology firms. So here's the OCC, which is really, in a lot of respects, the de facto kind of competition authority for big banks, in terms of merger review, in terms of licensing. And this is an extraordinary quote because for a number of reasons. Well, what Curry is essentially describing here is the type of thing that McKinsey consultants might do for their clients and get paid millions of dollars, right, to help them to kind of think strategically about leveraging this new technology and forming partnerships with these new competitors on the scene, potential competitors on the scene. And it's not the type of thing that you would expect from a regulator, especially not a competition enforcer, in an environment in which one of the biggest problems, arguably, is that banks are too big. But here's the twist, Tom Curry is known as being a really tough regulator with respect to banks. I mean, he did a tremendous job in so many ways in terms of enforcing the law. And so the competition problem, in my mind, is not necessarily about the individuals inside these regulators. It's about an institutional structure, really a regulatory architecture that just is poorly designed and leaves no agency with the right combination of authority and motivation to enforce competition policy. And so this matters because there are, to get to kind of really the heart of Sally's question, the first part of it at least, this matters because there's some potentially significant benefits to Goldman Sachs offering higher interest rates to consumer deposits, and to fintechs luring customers away from the largest banks and innovating ways to provide access to credit, both in terms of the lower costs for using basic services, and in terms of potentially keeping banks from being bigger than they might otherwise be. And so, you know, and so I found, you know, there's another more controversial upside, and that's to kind of more free climate for fintechs, and that's expanding access to the underbanked or even the unbanked. And the best research I've seen on this suggests that fintechs overall are helpful in expanding access to good credit. And granted, there are a lot that do the opposite and create problems. And so I'm not saying that we need to just kind of let them run wild, but I think improving competition doesn't mean deregulation. Fintechs can be allowed to compete with banks while still being appropriately regulated. And indeed, I think some of the biggest risks are about the mismatch between kind of more micro-focused regulators who pay attention to fintechs like the CFPB or the FTC, and the more macro-focused prudential regulators who are more removed from fintechs, but would be thinking about these bigger systemic risk issues. But in the interest of time, I'll just close by saying my broader point is that these consumer-level competition considerations currently seem to have no home in the financial regulatory architecture, but they need to be part of challenging the structural status quo, as Art is so skilled at doing. Thank you.
That's really provocative, Rory. Thank you. Hold that thought. We'll come back to that in a bit. So Kristen is an expert who's been writing a lot about capital markets in a variety of forms, securities, derivatives, and all of that stuff. And it would be really interesting to hear her thoughts on this sort of this principle of separation of banking and commerce, fintech, and all that stuff. Kristen?
Thanks so much, Sally. And actually, we'll hear lots right away from me, dovetailing what Rory has described. I've been enjoying your work so much, Rory. I see so many threads of what Art is espousing and encouraging us to think about in your work. So I am happy to take up the torch and follow you in several of the things that you mentioned. And I'm very grateful for Hillary laying foundational concepts as well in her remarks. But first, I really have to pause to say thank you to Erik for organizing, to the University of Colorado Law Review students for hosting us, and most importantly to Art for inspiring the work that will come in this generation and the next of law teachers and lawyers and regulators and policymakers as a result of your decades of teaching and instruction. So you leave a great legacy, and I hope to carry the torch in that as well. Let me begin by saying that Erik and I actually testified last month before the U.S. House Financial Services Committee, the subcommittee actually, on consumer financial protection and financial institutions. And we testified on this topic. So we actually have had quite the fun banter about this. And to Rory's point, Brian Brooks was on our panel, so lots there too. I thought one of the earlier panelists would have mentioned the following, which I will just go ahead and offer up. Our panel titled Banking Innovation or Regulatory Evasion, right? Exploring Modern Trends in Financial Institutions or Financial Charters, looked carefully at an issue that, of course, as always, Art had already presciently identified and explored in his writing and work, and even before the committee, just months before Erik and I had. So not surprising to anyone at all, Erik and I were the valiant vanguard. It was the case, in fact, that Art had already gone before us, in one instance, leading with Morgan Ricks in the writing or drafting of an amicus brief by law faculty from leading institutions around the country in supporting the New York Department of Financial Services claims that the OCC FinTech Charter violated many things, the Constitution, the 10th Amendment, which I hadn't read about since law school, and any number of sort of expectations regarding the limitation of agency supervision, oversight, and regulatory interpretation, right? So Art had gone before us. We were the valiant vanguard, but he was the cavalry. He had gone before in the context of the amicus brief and also in his testimony, challenging, sternly critiquing, and demanding that the OCC carefully think about these very partnerships that Rory mentioned, the potential to open the gateway, the floodgates, one could argue, to special purpose non-bank charters, permitting fintech firms to begin to operate as non-depository banking institutions. Now, this work was actually, or this discussion was actually well articulated in Art's own written testimony for the September hearing. Art described how the OCC's aggressive attempt, I'm using some euphemistic language there, Art was more forthright than I, but aggressive attempt to expand its own authority and allow national banks to form lending partnerships with non-bank lenders, to treat national banks as true lenders for loans produced through such partnerships to permit national banks to maintain their status as true lenders, even if they sell their entire interest in a loan to non-bank partners the day after the loans are made, essentially permitting the rent-a-charter scenario, which I suspect Saleh was headed to. So I won't linger there. I only pause to point that out because what I would like to focus my comments on really grows out of what I see as the inspiration art has had on me and my work. Essentially, Art's life work it establishes, and Peter was pointing this out very clearly in the previous panel, Art's work establishes a discussion and legitimizes the discussion of the political economy of banking regulation, which forces us to ask questions beyond general macroprudential policy and to start to question the way that banks operate in our society. With more time, I would probably quote Gerald Corrigan in his 1982 essay on why banks are special. But in the moment with limited time, I'll just point out two areas where I see the future of finance deeply impacted by Art's work, and that is disintermediation and decentralization. In the context of these two terms, I'm referring to the reality that fintech platforms, whether they be payments or non-bank, neobank, special banking institutions that don't accept deposits, are operating under the magical shroud of innovation. And they're being permitted to operate in a manner, to Rory's earlier point, that really essentially is tantamount to deregulation. This focus on disintermediation is not solely in the credit side of the market. It's certainly in the capital market side as well. I might quickly offer up the example of Coinbase as in their direct listing, their very recent direct listing. On the heels of Coinbase's direct listing, there are additional cryptocurrency or digital currency exchanges and other tech firms, right, that are seeking to enter into public securities markets without passing through that traditional gateway of relying on underwriting. I'd love to talk lots more about how cryptocurrency, one of the world's largest, Coinbase, one of the world's largest cryptocurrency exchanges, has distributed shares of common stock in a highly anticipated public offering without relying on that traditional platform that we would have anticipated underwriters. And the extent to which Coinbase also illustrates decentralization, because the argument for this nascent celebrated distributed digital ledger technology platform is that it offers genuine peer-to-peer transactional engagement. In many ways, it's true. In many ways, it isn't. And with one moment left to sort of highlight some of the concerns I think that arise from our mystification of technology and innovation, I would posit the following. We also see Wyoming offering a special purpose depository institution charter to Kraken Bank as of the end of last year, further expanding the ecosystem of entities that are engaged directly with consumers with potentially limited consumer protection, and even more significantly, growing concerns regarding the impact of these widely distributed, dispersed, if you will, financial institutions operating in the general banking or operating in the broader financial market space. I pause now just to say a final word on solutions, because Saleh asked us to think about the benefits and limitations of integrating a more diverse set of actors in this ecosystem. And I'd posit and happy to talk a lot more about two things. One, Hillary's own work here on sandboxes could be very instructive. Second, I'd like to think outside the box more. To Rory's point, I'm curious to know and would be hopeful that later in this symposium, there would be some discussion about technology-based solutions to regulations like API banking, right? Directly offering to consumers a government carefully monitored system whereby they can actually benefit from peer-to-peer transactions in the banking space with far fewer of the concerns that arise in innovation cloaked behind the name of artificial intelligence-based platforms or decentralized distributed digital ledger platforms. I'd like to sort of open the door, if you will, to let the light shine in, and quoting Justice Brandeis with respect to securities regulation, and making it plainer and clearer to consumers how these markets operate, and clearer for regulators as they structure regulation in the future of financial markets.
Thank you, guys. This is a lot of food for thought. So second round of questions, natural follow-up. Now what, right? What's the solution that you guys see to these really difficult issues that you've identified? So Hillary, you already started talking about it in your first kind of round of answers. And I'm extremely excited to hear you speak about antitrust issues, because as you know, of course, that's always been kind of one of the big themes in my own understanding of fintech. So I would like to push you a little bit and kind of see what your thoughts are. How would you see the principle of separating finance from commerce, if that's the principle you would like to endorse? Or how would you draw the line, and what kind of antitrust framework you might want to see, even in broad strokes? I realize it's a very big question, but that would be really interesting to hear from you.
All right, so thank you for the question. And before I get into it, I just want to make a clarifying point on particularly my framing versus Rory's framing, because they sound very different, but I think that's because we're talking about very different things, right? So when we're talking about fintech and the separation of banking and commerce or finance and commerce, we really have two things at stake. There are the tech fins and the fintechs, right? And the tech fins are Amazon, Google, the very largest institutions trying to break into tech. And then there are the fintechs, which are the small startups, and they do raise, very different issues from a competitive perspective. And when the fintechs, the small firms first started up, as that Rory was talking about, I was excited from a financial stability perspective. I was like, oh, maybe these guys will erode some of the market share of the too big to fail banks, and that will improve systemic stability. But instead, what we're seeing is that they just get eaten by the largest banks. And in fact, that's a problem that with the tech fins as well, because there's a huge nascent competitor problem. Amazon, Google, Facebook, they just acquire anybody who could potentially threaten their market share. So in terms of Saleh's question about what I would like to see, I'm not going to give a very good answer, because frankly, this is the part of my book that I've punted on, because I'm not in an antitrust or a competition perspective. I've just sort of recognized in many respects that there are limits to what financial regulation can do here, and something else needs to step in. But to the extent that I do have thoughts, I think this idea of preventing the acquisition of nascent competitors is a really big one. And I think that would help the fintechs that Rory's talking about to actually potentially grow and be a challenge to the more established financial services, to be creative, to diversify. And I think that the way that they do that technologically is really important too, because I've increasingly become interested in the infrastructural problems relating to financial stability. Like we've got all this, very complicated new tech to, delivering financial services. And we tend to think about, financial stability problems in the framing of, runs, credit problems. But infrastructural problems could, if they were persist long enough or widely spread enough, that could hurt the real economy too. And so I think, diversification of infrastructural solutions would be good for financial stability as well. So, giving these fintechs some room to breathe from a competition perspective makes sense to me. What I'm not so keen on, and Kristen kindly mentioned my work on sandboxes, is, these new programs that financial regulators are rolling out to sort of promote financial innovation by the private sector. They just seem a little off to me, honestly. Like that they're expensive, they're hugely resource intensive. And it's sort of, you're just sort of taking a gamble that the private sector will solve the problem that you want solved. But really the problems that we need solved are much bigger than a small startup is generally willing to risk itself on. So I'm not sure that they're the solution, the innovation hubs and the regulatory sandboxes. I do think that restrictions on acquisition of nascent competitors, and Amy Klobuchar has proposed a bill on this, I think that would be helpful, but I don't really know enough about antitrust law to figure out how exactly you would keep Amazon and Google and Facebook out of providing financial services, which I think is crucially important going forward. And I think, that there's only so much space in a book, but when it's done, I think it's time for me to start learning more about those issues, because I do think that's where the battle lines are going to be drawn going forward. So sorry to dodge and weave and evade your question, Saleh.
It's all right. It was the kind of a question to which there is clearly no answer just yet, right? But we're all working toward it, and I'm really happy that that you are tackling that issue. So Rory, it was very interesting to hear you talk about sort of the competition between fintechs and banking, and kind of the interesting, although not at all surprising, frankly, to me, position that OCC took on it, right? And it sort of makes me wonder what your view is on what kind of regulatory agency reform would you like to see to address these types of issues, given the fact that the market itself is shifting, right? The lines, old lines, banking and commerce, capital markets and lending markets, or what have you, are being completely blurred, right? Given that all these old jurisdictional divisions, like the OCC is trying to protect its own constituency like it's always done, or at least has done for the last several decades, seems to be at odds with potentially our interest in giving consumers greater access and great opportunities, right? So what kind of regulatory agency shakeup would you like to see in order to remedy this particular issue?
Yeah, and it's definitely a challenging task that we're facing in terms of designing the regulatory architecture. And actually, before I answer your direct question, I just want to say, like, I really enjoyed listening to both Kristen and Hillary's responses, and so many thoughts going through my mind that I'll hold back on answering, but I'd love to connect with you all on afterwards. I mean, the three of our bodies of scholarship connect in so many different ways that it's exciting. But to focus on your question, the UK's financial competition regulator, at the risk of, I realized earlier in the conference, we've been warned against, looking at what's been done in Europe and saying we have to do something similar, but this is a kind of different takeaway from another context. And that is that the UK's financial competition regulator had launched several programs to enable fintech startups to compete, had authorized fintechs to enter the market. And my sense is that the UK financial regulator has overall been closer, and not exactly what I'd want to see, but it's closer in the direction. And one of the reasons is that it doesn't have that same conflict that American regulators have. It's not charged with bank safety and soundness in the same way. And so I think one big step to fix this organizational dysfunction would be for Congress to reallocate authority to ensure that some regulatory body was focused on financial competition without a mission conflict, right? So right now the DOJ defers to the banking regulators defer to the, I don't want to go too far and say they defer to the banks, but they defer to what's in the bank's best interest in terms of safety and soundness, right? And so I think three possibilities for undoing this would be because one of the reasons that the DOJ defers to the banking regulators is because finance and banking are so complex that they think that the competition regulator really needs to have that deep institutional financial knowledge and expertise. And so I think one way would be to kind of create that somewhere else, like a unit that's solely focused. Because right now in the DOJ, the people that do banking, they're kind of generalists. They also do garbage collection services, or I don't know the exact how they divide it up internally, but I know it's the same group, right? And they have so few people, they have to do a bunch of different stuff. So you could create a group within the DOJ, that was focused on banking. I don't think that's the ideal solution, but that's one possibility. A better one would be the CFPB, giving it because right now it's a consumer protection regulator, giving it competition authority. I proposed that a couple years back, but very tentatively, or with great ambivalence, because I worry about the consumer protection mission getting kind of watered down in the process of absorbing competition, but maybe having a say in licensing and blocking mergers from a consumer welfare perspective. And then another possibility would be a new agency, kind of maybe more like the UK, that's kind of focused more on kind of market integrity, that's separate from the prudential regulators.
Rory, just a clarification. When you're referring to UK, you mean FCA, right? Financial Conduct Authority. Is that the
right? Yeah.
The agency you mean? Okay, I see. Go on. Sorry.
Yeah. So they separate out the prudential regulation in a way that we don't. And then I guess there's a whole other set of things. So first we need an entity that's focusing on competition and then there's a question of how do you coordinate all these different, to your point about jurisdiction, right? And FSOC, I realize it's kind of like wishful thinking, or where we all want FSOC to solve all our problems, but FSOC could play more of a role in that, where the CFPB or whatever competition authority were to say, no, we really need fintechs to do XYZ, and the OCC were saying, no, that's too bad for banks, it's too dangerous. Then we could have like a kind of mediator, if you will, tiebreaker through FSOC. I think that we may need more tools actually too, just to, if we do let fintechs go and they start directing large numbers of consumers potentially from bank to bank, say, or whatever it may be, and in more of an open banking context, to Kristen's point, which I'd love to speak a little bit more on at some point. But I do think there are some possibilities there, and just kind of like the CFPB swung and missed in the Dodd-Frank mandate to kind of think about open banking in my mind, because they didn't mandate anything. They issued guidance, and so I think there's some possibility there. But if we did do open banking, we'd need to have tools like maybe like a pause button where some central regulator could intervene if markets got out of hand. And so I have a whole set of like different interventions, but I'm going to stop because I've been talking for a while. But it's a tricky problem, and there's no one solution for sure.
Well, Rory, for sure, it is a tricky problem. There is no problem on today's agenda for this entire conference that isn't tricky, right? That's basically the water we're swimming in. So Kristen, you basically gave us a very wide-ranging set of remarks about very important issues. And there are so many things that you mentioned that kind of piqued my interest. But I was particularly interested in you mentioning this demystification of innovation and technology, right? And you brought up this question of the role of disclosure, sort of Brandeisian principle, right? The disinfecting effect of light. And I'm kind of curious to hear your thoughts about what the role of that type of disclosure type of regulation that is very much the bailiwick of the SEC, and the entire federal system of securities regulation, of course, is based on the principle of disclosure. In light of the fact that, as Hillary mentioned, as Rory kind of indirectly talked about, in light of the fact that it's the infrastructure, it's the structure of the market that now is determining so many issues that bubble up to the surface, what role for the disclosure-based regulation in your view?
Thanks so much, Sally. This is a really important question. I think that really takes us to that 30,000-foot view that I was mentioning earlier, where we carefully think about the role of banks in society and the justification for granting licenses or charters, or for permitting the operation of certain types of institutions within our society. And when we layer very complex technologies like artificial intelligence or distributed digital technology, which is long-term for blockchain, or at least a commonly used interchangeably with blockchain, I simply mean to suggest that to Rory's point, it gets complicated. And so where I'd like to begin is sort of hearing your question. I think I want to be exceptionally clear on 3 points: the promise of inclusion, the real potential harms for consumers, and this infrastructure point you make. So less than a minute on each, or a second, or 30 seconds on each. The promise of inclusion. Fintech firms have premised, in many instances, their justification for licensing on a promise of inclusion, a promise to include 33 million unbanked or underbanked Americans, and 1.7 billion global banking consumers, or would-be banking consumers. According to fintech proponents like PayPal CEO, those relegated to fringe financial services, relying on providers characterized by predatory or compounding and debilitating interest rates or excessive fees, will be liberated from this sort of usurious activity and invited to participate as one of the crowd in conventional financial services, or something that is the alternative to conventional financial services. They argue that fintech solves for discriminatory banking deserts, instances where people in communities like many that I've lived in have no access immediately or directly to a banking branch or an ATM, and it eradicates explicit and implicit biases. Think loan officers in sort of consumer loan context, right? So these are the promises that they've made. And in Brian Brooks' remarks at the hearing that I mentioned earlier, he touted all of these. But let's look quickly to the evidence. Bobby Bartlett at UC and a cohort of colleagues from the business school there have demonstrated that we have just cause to be equally concerned about the probability that the interest rates paid by consumers who seek artificial intelligence-based scoring platforms, right? Loans from artificial intelligence-based scoring platforms may face similar challenges to those who engage legacy financial institutions. So maybe we'll see the promises of fintech come to fruition, maybe not. But what I do think is apparent is that there are real concerns about privacy, about predatory, to invoke again our wonderful mentor and good friend, Pat McCoy. There are real concerns about predatory use of fintech technologies to attract, elicit, and entrap, essentially in some contexts, consumers, and our thoughtfulness that banks are meant to be in every instance a point of opportunity for consumers, rather than this kind of pressured place where coded bias and other concerns proliferate. My thoughts are the promise of inclusion may or may not pay off. We've seen failed attempts to protect consumers in a variety of contexts, from insurance to privacy, in provisions of the Gramm-Leach-Bliley Act, in fact, and then later in the Dodd-Frank Act, consumer financial privacy just fell through the cracks, like right through a sieve. And then ultimately, to your point about infrastructure, this is, I think, where the real work could be done. And there are so many questions unresolved and unanswered, and our panel won't have time to begin to explore all of them. But Saleh, your astute and thoughtful examination of our remarks really has evoked, in the context of this panel, lots of thoughts I hope that will germinate through the course of the day and across our conversations well beyond today, as art's legacy teaches us. So thank you, Saleh, for mentoring us in that way. You have certainly been that to me, as Art has been, as Erik has been, and others who are joining in today's conversation.
Well, thank you so much, Kristen, and thank you everybody, Hillary, Rory, Kristen. Thank you, Erik, for organizing everything. Once again, congratulations, Art. We have only begun talking about a lot of issues that your work opens up for the rest of us. Still lots of work ahead. Thank you. Bye.
Thank you to Saleh for moderating. Great panel. Thank you to Rory, Kristen, and Hillary for insights into one of the most pressing issues of financial regulation that we're facing right now. We keep rolling on with more all-star panels. Our next one is no exception. We are delighted to have a fireside chat featuring two of the most prominent figures in prudential regulation in recent decades. The Honorable Tom Honig, who was formerly Vice Chair of the FDIC and is currently at the Mercatus Center of George Mason University, as well as William Cohen, who was the Secretary General of the Basel Committee on Banking Supervision and is currently Vice Chair at Reference Point. Moderating this fall all-star fireside chat is Jeremy Pam. My thanks to Jeremy for doing amazing work helping make this conference possible. We owe you quite a debt, Jeremy, for all your work at George Washington with Art. And thank you so much for helping make this conference possible. We'll now turn it over to Jeremy.
Thank you, Erik. Can you hear me okay?
Yes.
It's been a pleasure. Terrific. Erik, it's been a pleasure working with you on this conference. First, let me join those who preceded me in expressing my appreciation of and admiration for Art Wilmarth. Having had the good fortune of having Art as a colleague, I've learned a great deal from his work and thinking on the subjects of this conference, have benefited from his collegial generosity, including introducing me to both our panelists in this fireside chat, and have always appreciated his kind spirit. Even beyond the subjects of his book in this conference, I've greatly enjoyed sharing a never-ending conversation with him about the broader puzzle of the nature of and professional supports for or hindrances to the old-fashioned ideals of statesmanship and sound judgment, or even wisdom in policy generally. Now I'm pleased to briefly introduce our two speakers in this fireside chat, Bill Cohn and Tom Honig. Bill Cohn's 20-year career with the Basel Committee on Banking Supervision culminated with his tenure as Secretary General from 2014 to 2019, during which he directed the work of the Basel Committee and managed the Secretariat, and chaired the Basel Committee's Policy Development Group, which developed and recommended the Basel III post-crisis reforms for endorsement by the Basel Committee. Bill's many post-Basel Committee roles include, just to mention a couple, serving as chairman of the IFRS Advisory Council supporting the International Financial Reporting Standards Foundation and the International Accounting Standards Board, and serving as a board member and chair of the Audit Committee of the Toronto Leadership Center. Tom Honig is well known to many of you participating today and in the audience as the former vice chairman of the FDIC from 2012 until 2018. And before that, for 20 years as president of the Kansas City Fed and a member of the Federal Reserve System's Federal Open Market Committee from 1991 to 2011. Since stepping down from the FDIC, Tom has been a distinguished senior fellow at the Mercatus Center at George Mason University and a professorial lecturer at GW Law School, where I had the great pleasure of co-teaching a course on financial stability with him. With that, let me turn it over to Bill and Tom. Just to start things off, as the three of us have discussed, I've been struck, like some previous participants, by the question of how the discussion about regulating megabanks today in 2021 compares to those at previous times in the past of your professional lives. The financial crisis is obviously one crucial point of reference, and it's already been discussed many times in previous panels, but given both of your long careers as regulators and policy officials, I wonder if you have any thoughts about how your perspective on the proposals in Art's book, for example, separating commercial banks from the capital markets and shrinking the shadow banking system by limiting the issuance of short-term debt obligations to banks, today compares to how your thoughts about these questions, to your thoughts about these questions, for instance, during the 80s and 90s, and also during the few years after the passage of Dodd-Frank, when, as Paul Tucker noted earlier, thinking about how to understand the nature of the problem was, whether it was size, capital requirements, complexity, the issuance of safe assets, was continuing to evolve. Why don't I start with you, Tom?
Okay. Well, thank you. First of all, it's good to be on the program. Art and I have worked together in the past as well, and very much appreciate the book that he recently completed, which is a great history of the whole issue of these very large and complex financial institutions. I will tell you that the thinking on this has evolved in the sense of in the 80s, the whole idea of the consolidation of the industry was, shall we say, up in the air. There was a lot of discussion, but uncertainty about going that way. But the financial crisis that occurred in the 80s and in the 90s, early 90s, led to the fact that you had to do something, someone had to be able to acquire to carry on, because even back then there was concern that these institutions were just too big to fail. In the early 90s was one of the first official times in the legislative discussions that there was this reference to too big to fail. And I think that was kind of looked past when we went up and brought forward the Bramlage-Wiley Act that allowed Citi to merge with Travelers and to continue to build a consolidated financial industry. And that continued through the good part of the 2000s until we had the crisis. And what the crisis did was confirm that these institutions, it's not an issue of just being big. The issue is if an institution under a capitalistic system is too big to fail, the system can't work properly. And we saw that. We saw major bailouts from the taxpayers, a great deal of resentment among the general public, and you had this kind of a pushback, but it was only partially a pushback, probably to Art's frustration, And that is you tried to introduce it with Dodd-Frank, a whole new set of rules and efforts to impose some limits, but not really eliminate the issue of too big to fail. And part of that turns on the point that over this same period, over these 20 years plus, what is going on also is the extension of the safety net to an ever greater number of institutions. And that safety net makes it even more difficult to simplify these institutions because with the safety net, you now have an obligation to a greater number. The public understand it to be a greater obligation, and therefore the whole idea of breaking them up becomes increasingly difficult. And that's the challenge you face today. Even with the current administration and a great deal of talk on both the conservative side and the liberal side, this understanding that there is a very significant consolidation in the industry that needs to be addressed, but no one really knows quite how to do it. And that's the challenges that are only going to get worse as this panel that just finished turns to the topic of fintechs and tech fins and the further expansion of the safety net. So that's kind of a broad view of the situation and the difficulties going forward, in my opinion.
Great, thanks, Bill.
Thanks, Jeremy. And thanks to Jeremy and Erik for inviting me. When you first asked me, the opportunity to participate in something with Tom Honig, whom I've known for a long time, both our days at the Fed and then when Tom was with the FDIC and I was in Basel, I jumped at the chance. But then when I learned that the conference was to congratulate Art, I definitely couldn't resist. So first let me say my appreciation for my congratulations to Art for his leadership, his thought leadership in this really complex world. I'm not going to disagree with anything Tom just said. In fact, I'll even take it a step further. I'll agree with everything Tom just said, but I'm going to offer a slightly more sanguine view. It reminds me when I hadn't testified for the French Senate a couple of years ago. They were grilling me on Basel III, and I started my testimony in French. I said, the more things change, the more they remain the same. And the senators all looked, oh, this is what a pleasant surprise. We're going to have this discussion in French. They were sorely disappointed because that's my very limited French. That's about as far as I can go. And I've been fond of that expression to say, risks don't change. The way characteristics change, the way they manifest themselves change. And so, I was very fond of that expression that things haven't changed. We're going to have crises. They're going to take very similar forms as they've had in the past. But I'm going to back away from that position a little bit. Yeah, the world has changed in the last 100 years. The world has changed dramatically in the last 15 to 20 years, let alone last 5 to 10. I think and Tom had mentioned, and the panel before this had mentioned the FinTech challenge. The world is so dramatically different. The way financial services are delivered these days, the innovations in not only financial services, but the technology behind it that has led to the delivery of those services. I don't think we could prevent crises. I've spent, the better part of my career in Basel, which is, the Bank for International Settlements has a terrific research function, rivals that of the New York Fed, the Fed Board, Bank of England, and others. They do a terrific job research. I've looked at, I've been involved in a lot of the work. I've looked at a lot of the data. I've read a lot of the research and the analyses. And we know financial crisis is going to take place, let's be generous and say every 10 years. It's a little more often than that. So I humbly say, as a former regulator, policymaker, we're not going to prevent a crisis. The best we can do is mitigate a crisis. The world has changed. Regulators and supervisors need to change. So I'm very conscious of the fact that we will continue to have these pressures. I think they will arise in one form or another. I take Tom's point to heart that, well, yeah, the safety net has been expanded and expanded and expanded some more. I think the changes that we've made with Basel III, and Jeremy, you're not going to be surprised to hear me say I'm I'm a big supporter of Basel III. I just think what we've done there with this multiple metrics approach, we've always had the risk based, and I'm talking globally, and I come from a lot of this from a global perspective. We've always had the risk-based capital ratios in the last 20 years, 30 years or so. On a global basis, we now have a leverage ratio. We have a liquidity standard. We have a funding standard. We've made improvements in large exposures, counterparty credit risk, exposures to CCPs. I think the system has been improved a tremendous amount. What worries me is curtailing the activity of banks. I've seen too many times that, I don't like to use the word unintended consequences, because the industry would always say, Bill, and you fools in Basel, you have no idea of the unintended consequences that you're that you're going to give rise to because of these, the higher capital and better capital and leverage ratio and all that. I do wonder, though, about incentives. And that's the one thing as a policymaker, I was always thinking, so what kind of incentive does this give rise to by enforcing or developing a policy, having it implemented? It's hard to see down the road what those incentives are. I think the best we can do, and I think we've come a long way. We've introduced measures to make the system safer. And I think, again, my bottom line as regulators and supervisors, and I hope I have the chance to make that distinction again. That is so important in my view, regulation and supervision. I think the best we can do is to continue to adapt to the operating environment in which banks serve and operate.
And Bill, I agree with that. My concern is when you talk about incentives, that's really part of what my concern is. When you change the incentive game with a safety net that is ever expanding, and then what happens when you have that incentive? Then the creditor and even the investor in the equity side sees bailouts. Their role in the disciplinary process for these institutions is weakened. And then what you get is significant leverage. And I agree that the banks under Basel III are better capitalized, but from a leverage ratio point of view, they're in my opinion, Europe's average is a little more than 5% on the supplemental leverage, the US around 6%. We had losses in the last crisis of 6% in the US, but these are marginal numbers. And they say, well, we're so much better capitalized, but in the pandemic, which was totally different than other financial crises, they referred to that as, well, the banks did so much better this time, but the Fed stepped in so much quicker and so much more vigorously than they did last time. Again, expanding, deepening the safety net so that the behavior around that, again, will change as incentives encourage further leverage, as I think we're already seeing. And when you think of that, when you think about that, the leverage that was part of the solution to the last crisis is the fact that in 2011, in the US alone, the debt was around $11 trillion. Today it's over 30 trillion in a little more than a decade. So we're incenting all right, but we're also, it's not free. It's not something that we're learning from in the sense of tightening up our standards, investors insisting on more capital, because we know there's a backstop to it. And I think therein lies the demise of a market system in time. And there's no better example of that in the US than the student loan market. So you've got to bring some kind of if you're going to have a market capitalistic system, you've got to bring a market capitalistic discipline to the process.
Let me have a quick response to that. And Tom, you were probably being a bit generous when you said the leverage ratio in Europe for the big banks is around 5%. I think for the really big banks, it's probably south of that by a not immaterial amount. again, I approach this from a global perspective, and Tom, you were vice chair of the FDIC when the discussions about not even should we have not even the calibration of a global leverage ratio, but should there be a leverage ratio? I remember well, we consulted in 2009. We couldn't even call it a leverage ratio. It was that anathema to the rest of the world. We had to call it a supplemental non-risk-based capital measure. And then, finally, sensibly, people saw right through that and knew what we were talking about. So I think to get 3% as a minimum, a global minimum, I know that's not where we want to be. That's not, that's not the right measure, but it's a good start. And we have to, we had to do what was politically feasible to get a leverage ratio in place. And the other thing that comes to mind, you talk about market discipline or the discipline exerted by large shareholders, counterparties, including other banks. This is something that failed, I think, dramatically in the global financial crisis. Was it because lack of data? There was lots of data. People didn't look at it. And I think that's one of the changes. So I constantly, I'm somewhat confounded by the lack of focus on things that I find equally important to regulation. Things like effective supervision, effective risk management, robust, rigorous corporate governance. So I see during the global financial crisis, it was, it was the confluence, it was the perfect storm, the confluence of a number of events. It wasn't just weak capital. It was a lack of market discipline. It was a lack of effective supervision. I think we've made terrific strides, not just in Basel. I think the US and I think a lot of the jurisdictions around the world that were affected by the global financial crisis, I think they've made tremendous strides in improving those areas. So have the credit rating agencies, so have the accounting standard setting bodies, investors as well. So again, that's why I'm taking a slightly more sanguine approach, because I do think there's so many factors at play beyond regulation, beyond bank structure.
Yeah, well, no, I certainly agree with it. It's more than bank regulation, because bank regulation is only as good as the regulator. And in good times, they sometimes are every bit as euphoric as the management, who thinks nothing can go wrong. And if something goes wrong and the government steps in and bails everyone out, nothing's learned, except that the government steps in and bails everyone out. And so you saw it in the Mexican crisis, you saw it in the Asian crisis, you saw it in the Russian crisis. You see this desire and need to step in because you have crisis, but you don't want anyone hurt. And over time, though, the size of the shall we say, dislocations that occur grow, so that the need to step in becomes ever greater. And that's really why I agree with you. It's very difficult to get the capital ratios up because of the pushback, but that would be a huge incentive, more to lose, at least among that group, because creditors aren't going to lose. They're going to be, the debt's going to be in the bank. Even under the U.S. systems, the Treasury will step in. Those lessons have been learned well, and they are what I think drives behavior going forward. So we'll see.
Just to invite you to elaborate a little further on this, and drawing on both of your experiences as regulators and policy officials, what do you think, to the extent you've heard any of the other panels so far, and from your understanding of Art's proposals, is there anything from the perspective from a practical regulatory perspective of actually implementing financial regulation and conducting supervision? Are there things that you think are currently underappreciated or underappreciated perhaps in the reform proposals, or market dynamics that are underappreciated that require a different regulatory or policy response?
Let me, if I may, Tom, let me jump in on that. Yeah, I think the reaction to this past crisis was so well done, and as the expression goes, experience is the best teacher. I think the Fed, the other agencies, I think even overseas, the central banks, the authorities overseas, I think the rapidity with which they move, the decisive actions, big actions, very early on was very effective, and so was the cross-border cooperation, and that's I think mainly because of the experience from 12 years prior during the global financial crisis when there was no playbook. This time there was a playbook. Fast forward to today, what have we learned? What's still missing? I'll harp on this point about regulation, and for someone like me who's spent a good part of my career developing standards that are ultimately transposed into rules or regulation or law, depending on the jurisdiction, I very humbly say, if you're going to focus on regulation, you're missing the boat. I always like the analogy, regulation are like speed limits. You've got to have speed limits. You've got to have boundaries, but you've got to have people to enforce the speed limits. Without someone to enforce the speed limits or those parameters, those boundaries, well, then the rules, the regulations become effective. And I'll take it a step further, and that is you've got to have people on the road who know how to drive the vehicles. So the rules protect, if they're followed, the rules protect people from getting hurt, including the driver or the participants in the financial system. But you're not going to put somebody on the road who doesn't know what they're doing. An unlicensed, inexperienced driver is a hazard to themselves and to everyone else on the road, or in my analogy, the system. So I think we've got rules. Do we have proper supervision? I think so. I think, and I've seen how supervision works in every jurisdiction around the world. The U.S. authorities have a tremendous amount of authority that most jurisdictions around the world would love to have what the U.S. has in terms of authority. So I think that's, we need to continue to focus on supervision, putting the rules in place. And banks, risk management, boards, and that's one of the roles of supervisors, to focus on risk management. Banks, this continual need to improve risk management, IT capabilities. Is the board providing the kind of governance that they need to provide? That's something that we clearly learned from the last global financial crisis. I know, and I'm confident that supervisors here in the US and those abroad will continue to focus on those things. So I do understand the importance of regulation, but I think it's easy to overlook the role of supervision, the role of the board, senior management, IT, and risk management. Again, just there are so many factors involved here, and I think regulation kind of unfairly attracts too much attention sometimes.
Yeah, I think Bill makes good points. I would add, or maybe even repeat a little bit, but I think in this last crisis, there was indeed, in the sense of having learned from the last one, very prompt action, and there was no equivocating. There was no going one way and then changing, and that made that solution work much more quickly. And it was massive. Let's face it, it was massive. So you learn from the immediate crisis, and then the jury's still out on how well we do going forward. But at least from that point of view, I think we have good outcomes. On the second, I think I agree also that supervision is critical. The rules right now are incredibly complex. And I think that makes gaming the system easier. So one of the things if it's possible, and that's no small task, to focus on, pretty direct, understandable rules. And then it comes back to my never-ending plea for, I would take stronger capital, because stronger capital gives the management more room to make mistakes, more time to correct mistakes. It gives supervisors more time to identify problems and more time to correct problems. When you're on the margin, and I think most of these largest institutions are, then those things go away, and that makes intervention by the government almost more necessary, given the size of the safety that we have and the implications of these very large, complex, heavily insured and backstopped institutions going forward. So in supervision then, yes, they have to know what the rules are, those who both the management and the directors and the supervisors, and then how you enforce that as a director, making sure that your management is doing what is expected of them, and then supervisors also making sure that that institution is doing what's expected of them. Those are the kinds of the key ingredients, I think, I agree with Bill's original point, not to end crises, because they're not going to end, but to mitigate the consequences of those crises and to build the resilience of the institutions that we all depend upon so greatly. And those are the sorts of things going forward, I hope we keep in mind as we kind of pat ourselves on the back for having done well on this last crisis, that we think ahead to what we're going to do the next crisis, which may be a financial crisis again, who knows? But those are the sorts of things that I think about.
Tom, Jeremy, if I may, let me just reinforce two things that Tom said that I feel very strongly about: capital and complexity. I've spent an enormous part of my career, particularly the last 5 years, as the person responsible for the Basel Committee. I spent a tremendous amount of time speaking with banks, trade associations, academics, politicians. That was part of my job, to hear any and all views. And I was always really surprised by this discussion about basis points, trying to get capital down to basis points. And I'd hear from a lot of, well, let's let me not pick on Europe, but I'd hear from European parliamentarians and the trade associations as well, to say, the European banks are different and they can't operate at the same levels of capital. The U.S. banks, it's not, they're not going to, that's a recipe for disaster. And the European banks are different, and operating with such little leverage, well, you can't survive in that kind of environment, I was told. And gladly, I had the opportunity before I left Basel, which was the middle of 2019. I would point to banks, not just the U.S., but I would point to banks certainly in the U.S., Australia, other jurisdictions that show you can, that's a source of strength, capital. It's not a burden. The media likes to portray capital as something bank has to hold capital. No, you have to have capital to fund your investments. Like any of us making an investment, you have to fund your own investments with maybe borrowed funds, but preferably your own money. So I just can't impress upon everyone at this conference the importance of capital. As Tom says, it provides a tremendous amount of flexibility, room for maneuver, and that's exactly right. The other thing is complexity, and I think the U.S. approach is a good one. This whole tailoring approach. In Basel, we were fond of saying proportionality. It's the same thing. The rules are so complex. Part of that is because of the industry saying, they want to be part of the process. They, we, the standard setting body, we had to, take account of their views of how the way the business works, how the risks are managed. So a lot of it is from the industry, but it wasn't always nefarious. I think there was some good intentions there. But as we've done here in the U.S., you can tailor the rules. If you've got a subset of banks that are just not that complex. They don't have market risk. They don't have a lot of counterparty credit risk. Well, maybe don't hold them to those rules. They are complex, maybe over-engineered. In some cases, in some cases, yes, I think they are. We could have done better, but it's a function of negotiation, a function of, I don't think we like to say lobbying anymore, advocacy, bank advocacy. I think it was, I think that was part of it as well. So the rules are complex, but jurisdictions really have the opportunity to apply a very minimum subset to less complex banks. And I'm pleased to see that the US has done it. Several other jurisdictions have as well.
So you mentioned, you both have mentioned the response to the current COVID crisis, and I think, Tom, you said perhaps the next crisis will be another financial crisis rather than an exogenous shock. Do you think that, as a practical matter, given current regulation and current incentives, the procedures for resolving financial institutions will work in the next financial crisis?
Well, you want me to take it, or Bill, do you want to start? I'm gonna.
Tom, I'd like for you to start.
I think that I think we're better prepared for the next crisis, but I think there will be bailouts. And why do I say that? Well, we will, I think maybe perhaps, hopefully, the supervisors will step in a little earlier this time and say, don't pay dividends. We see the writing on the wall. We see the losses mounting. Stop paying dividends and stop buying your stock back. And even in this last pandemic, they stepped forward in many cases and said that, and that's a big plus. So I think that's a good thing, and that would give more time perhaps. But in the end, I don't think one of the largest institutions in the US, perhaps in the world, any of the very largest, could fail without it having systemic effects, without it having contagion effects that would require the governments to step in. Even in the pandemic, remember, and we justified it, and I think properly so, but we stepped in. The government stepped in a big way. In fact, it extended its safety net. It not only lent to banks, but the Fed lent to businesses. The government lent and transferred more money to individuals and small businesses. Those are all things that help mitigate that problem. And I cannot imagine any administration in the future who would face a major financial crisis and a major risk of an institution of immense size or complexity, as they currently are, failing and walking away from that. So there'll be an intervention. Will it be, will the stockholders lose? Maybe, but probably not. I think they would intervene before then. And so, again, you'll learn, hopefully it doesn't cost the taxpayer as much because they're better capitalized. Hopefully they act sooner so they're not paying out their capital during the crisis. But there will be, I think, a need to step in by the government, even given the living wills, single point of entry, TLAC, all those terms, I don't think will stop them from having to step in. And one example I'd give you would be TLAC, total loss absorbing capital, because we saw that when the markets thought something was going to go wrong, they started selling off that particular kind of debt, then raising new questions about the solvency of the institution made things worse. So, the unintended consequences, as we sometimes talk about, are always there. And I think the government, given the size, importance, complexity of these institutions, will again step in the next crisis.
Yeah, Tom puts it very good. I wish I could, in this case, I wish I could be more sanguine, but I'm afraid I can't. I think for the next crisis, and hopefully it'll not involve a systemically important bank. But if it does, I think things like TLAC, single point of entry, multiple point of entry, the living wills, and all the other resolution measures, the war games that the FDIC would participate in with the Bank of England or the ECB single supervisory mechanism, how to resolve a big bank should it tip over. I think all that is important, really important work. I think it'll mitigate the fallout from a large bank failure, but I don't think it's going to prevent it. I think on TLAC, I mean, I was always a bit befuddled by TLAC. I mean, we talk about complexity. I think the capital structure of banks has gotten really complex. Basel III defines tier 2 capital as gone concern capital, and then TLAC comes along, and it's okay. It's not exactly the same, but I think it's one of those things that I think most people would agree on paper. It sounds like it's a good idea. It's going to work. We don't really know in practice, and we really won't know until we have some kind of a failure. But in the aggregate, any more capital is a good thing. But again, the other measures, I don't think they're meant to prevent a failure. I think they will certainly help what's going to be a bad situation. But I don't think we've gotten to the point where we could really say too big to fail has been solved.
Then to turn to another topic that there's already been a little bit of discussion about, how does the introduction, how do you see the rise of fintechs or tech fins affecting these dynamics? Does it change your initial sanguine assessment, Bill? Does it alter or reinforce your assessments, Tom?
Jeremy, there was, I realized we did an awful lot in Basel, and in the U.S. that's been transposed into a big part of Dodd-Frank, and all the jurisdictions that are members of the Basel Committee have adopted Basel III, and it's still being implemented. So I realize how much this involves from a bank's perspective. Just the IT changes alone, enormous. So I have a certain amount of sympathy, but that's sort of the price one has to pay to participate in the financial system at that level. But I always thought it was amusing that people would say, "Would you idiots in Basel, would you stop? We've got enough. It's like trying to drink water through a fire hose." And again, I had a little bit of sympathy, maybe less so because of the really extended implementation timeline. And that was 2013, 2014. Around 2016, 2017, the same bankers and trade associations were telling me, "What are you guys in Basel doing? You have to. We need more regulation. The fintechs are killing us. We need you need to regulate these guys." So it was quite a it was quite a turnaround. I would ask them, regulation is not going to solve your problem. Regulation is not your problem, and I don't think. And believe it or not, I firmly believe a regulatory response is often the second or third or fourth best response. The best response is, okay, I've got a problem. I'm a banker. I'm a risk manager. I'm a member of the board of directors. We've got a problem. We need to address it on our own. So I started asking the banks and the trades, what are banks doing to meet the fintech challenge? And just a quick anecdote, I'm conscious of time, but when I lived in Switzerland, we still had investments or bills to pay here in the US. I got paid in Swiss francs. I'd buy dollars with my francs and I'd send them over to the US. I'd bank with one of the large Swiss banks. And then somebody turned me on, a young person who worked for me said, "Why are you doing it that way? It takes too much time and they charge exorbitant fees." So I found a company, a non-bank, that would convert my money and send it the same day. Shocking. Well, the bank I used to bank, I was banking with, they called me a few months later and they said, "Oh, we noticed you don't use this anymore for FX transactions." And they said, "Well, I got a better deal." And they said, "You should have told us. We'd give you the same deal." That's not a good way. That's not a good way to operate. So you rely on a consumer's ignorance to hope that they don't know that they're getting a crappy deal. And so again, I go back to the point: what are banks doing to improve their lot? How are they becoming more competitive in this fintech space? It's a little more complex than that, I realize, but I think the first step should be the bank saying, we need to compete, we need to improve.
I agree with Bill on that. I recall when the whole issue of the elimination of Glass-Steagall was on the table through a good part of the late 80s and 90s, and the industry pretty much got it accomplished before the statute was changed. And the point of that is, if you think that legislation is going to stop the progress of the technology and the payments technology that is developing, you are on a very dangerous path if that's what you're betting on for your survival. So the fintechs are moving, they're innovating, they're forcing the banks to innovate. I think in that sense, it's good. I think there is an issue, and I saw the previous panel, and their definition of fintech and tech fin, but there is an issue with the largest of the Amazons and the Facebooks and so forth, who are also very heavily involved, potentially either already are or potentially involved in commerce, also becoming then basically banks, because if they take consumer credit and they hold it as an account, which they can then transfer, they're now in the deposit business. If they're making loans based on the balances that they keep, they're in the lending business. And so the banking and commerce issue is one where I would like to think that the policymakers, both the administrators, that is the feds and the OCCs and the FDICs of the world and the SECs, and the Congress would say, wait a minute, we better think about this before it happens and we have a blow up than after, and think through these very difficult issues. If they do that, I think we can have some pretty good outcomes. I think on the side, fintechs are going to proceed. If they're startups, they'll work their way through it. We're seeing that every day as they push the boundaries, if you will, and that's going to proceed. And the longer that the policymaker waits to decide how it should occur, then the more I think it will occur on its own. And then we'll see what the outcome is, good or bad, and what the consequences are, good or bad. But it is going to proceed very, very rapidly, in my opinion. Technology is just too enticing to the consumer, especially the young person who is used to technology. They're ready for it. They are ready for it now.
Tom, if I could just add to that, the one thing that I don't have a good answer for this, but I know in the US and most jurisdictions that I became familiar with, this isn't just, it's not really a regulatory issue per se, it's a legislative issue. And it involves expanding the scope of the perimeter of regulation. That's a tricky issue. You talk about complexity, that's a complex issue. I don't know how we could do that in the US. I know how in Australia, there was an effort to not go the legislative route. I think the jury is still out there, but that's an added complexity. You introduce legislation into a regulatory issue, and it becomes difficult.
And I would add that again, one of my concerns always is that as you expand access to payments and those who are engaged in the business, to fintechs, to others, to the extent that they do become larger and even become affiliates of a bank, that themselves become larger, or if the largest so-called technology companies get involved in the banking business, then you have to ask, do you want the safety net to go that wide? Because if they were to get in trouble, as GE did, are they going to require a bailout themselves? Are they going to require access to the discount window themselves? And I think one of the panelists before us mentioned this Wyoming company. If they become part of the payment system, even though they say that they would not be making loans, would they be, if they were to get in trouble for whatever reason, would they then look to the Fed for help? And then have you expanded the safety net and you haven't thought about it in advance? And those are the sorts of things that I think policymakers need to focus on now before they are forced to in a chaotic environment like a crisis.
We still have a few minutes, but in terms of just to invite you to give a sort of choose where you want to focus your final comments. We've talked about the response to the COVID crisis. We've talked about the response to Fintechs. Do you have any thoughts about the state of regulation of non-banks? Next topic, cryptocurrencies. Further, next topic, continued low interest rate environment. If that's the case. And finally, your assessment of the state of banking culture. You can choose any or all of those to respond to.
I'll go first and let Tom have the last word. Jeremy, what you just talked about, it's a great illustration. It's an incredibly difficult operating environment for banks. You've got compressed net interest margins. You've got, we've been talking about the fintech challenge in competition. In many jurisdictions, maybe not so much the US, but in a lot of jurisdictions around the world, they still struggle with asset quality issues, non-performing loan issues, overbanked markets, very competitive banking markets. So not only getting competition from non-banks, but from banks themselves. Yeah, it's a difficult environment. I do like to, the crypto issue is a fascinating one for me. I think when people think crypto, they think Bitcoin, Ether, and the other crypto assets. I don't call, coming from the BIS, it's been drummed into me. It's not an asset. It's not a currency. There's no guarantee. There's no intrinsic value. There's, it's not backed by issued or by an authority or a government. So, but this is a space I watch very carefully, and it's not about the coins themselves. It's about the technology. I am convinced. Tom mentioned a moment ago the payment systems. So the degree to which companies are now taking advantage of blockchain technology, distributed ledger technology, in the payments realm is just incredible. And we're talking about financial innovation, and as consumers, we're reaping the benefits of that. For banks, it's yet another challenge. But so I'm not so sure what's going to happen with Bitcoin and Ether. I do think that's highly speculative. But I think the technology that underpins it, that I am convinced is here to stay, and that's a space that regulators and banks have to watch very carefully.
Yeah, Jeremy, I would end on the following note because of my background. But one of the things that gives me pause and concern is that, understandably, monetary authority, governments globally are involved in terms of a policy of really encouraging, from a monetary policy, encouraging the, shall we say, the economy to take on more debt, to take on more risk. That's what zero interest rates are about. That's what that whole thing is about. And yet you expect macro-prudential supervision to control that risk. And what a difficult conflict that is, to have a massive effort to encourage risk-taking, because you shift out of these low interest rate kinds of investments into higher return, higher risk investments. And yet on the macro-prudential side, you don't want these institutions taking on too much risk. And so I think that could be a source of conflict, a source of confusion going forward that may actually contribute to a future crisis if one should occur, which I hope it never does. But taking Bill's original point, I agree with him, it will. And so how do we think about that? I think is something for careful consideration.
Well, thank you to Tom and Bill for truly enlightening lunchtime hour. That was fantastic. I'm definitely inviting both of you to my next conference. It'll be interesting to get a follow-up insights from you both. Thank you so much. Thank you particularly to Jeremy again for helping to organize this conference and make it all possible. I owe you a debt of gratitude as well as Art and your former colleagues. We are going to turn now to a conversation with the man of the hour, the man of the day, Art Wilmarth. And I am going to take a moment to introduce his interlocutor, who was quite literally the first person on my invite list when we concocted this panel. Like Art, Pat McCoy is a titan in our field, and like Art, she is humble and generous. She is also, together with Heidi Schooner and Anna Gelpern, part of the core fan club of Art Wilmarth, and has been for years. Pat is the Liberty Mutual Professor of Law at Boston College Law School. She is an expert in banking law, insurance law, consumer financial protection. She was also one of the first legal scholars to sound the alarm on the subprime mortgage markets as risk started to develop and consumer abuses started to develop there in the early 2000s. And she co-authored one of the best books on the financial crisis. Together with Kathleen Engel, she was the co-author of Subprime Virus. So I will now turn it over to you, Pat, to grill our favorite banking law colleague.
Erik, I wanted to join the chorus by saying many, many thanks to you for organizing what is such an impressive conference. There are very few Zoom events imaginable where one would tune in at 9 o'clock and not be able to rip yourself away from the computer until 5 p.m., but this is definitely it. So today I have the distinct honor of hosting today's luncheon conversation with Art. Now I have to say it's hard for me to imagine, but Art and I go back almost 30 years. And even at that point, Art was a very experienced academic. I first met Art in the mid-1990s at a conference at GW. I was pretty new to academia, and I gotta say, I was on the faculty of a not exactly elite law school. But none of that mattered to Art. We started talking. We discovered that we had this strange and mutual passion for all things banking. And nobody could have been kinder or more generous. And I think it's quite striking that those words, kind and generous, appear again and again in today's comments. Art was my first and most important mentor, first in my early years in academia, and then in later years when I started writing about subprime loans. And my scholarship did not exactly meet with enthusiasm from regulators or industry, let alone let alone the academic community in many quarters. He generously read my drafts, and I every once in a while I'd be in DC, and he would always drop everything to meet me. We'd go over to 2000 Pennsylvania Avenue Northwest, which had various eateries, and over coffee or a meal, we would brainstorm about the state of banking. I would always walk away in awe of Art's deep knowledge, his brilliance, and his zeal, his utter passion for his scholarly pursuits. Art's experience of banking and banking law is as long as his career. He actually lived through the disintermediation of the 70s, the subsequent spike in inflation, the bailout of continental Illinois, the savings and loan crisis. He remembers the Russian ruble crisis and long-term capital management, the dot-com crash, Enron, and of course, the 2008 financial crisis. Not many academics in our business have such a long memory. We can see Art's concern with the scope and size of banks and the perimeter of the social safety net in his writings. It's really quite astonishing. I didn't realize this until yesterday, as far back as the early 1980s. Those early years included works by Art on interstate banking, bank merger policy, the dual banking system, and the separation between banking and commerce. All very important topics still today. From the 1990s through 2008, Art expanded on these themes. Now, if you think about this period, let's start around 1990. You could go back a few years earlier than that. The mainstream was moving in the direction of interstate banking, and then the dismantling of Glass-Steagall and the final accomplishment, the coup de grace in that respect. And this was also in academe, the heyday of neoclassical economics, a very rigid view of law and economics, one that was not empirically informed for the most part. And Art swam alone, practically upstream against all of these trends. You know, you don't just take on one Art, you got to take them all on. He was, I think it's fair to say, ignored by the mainstream banking regulatory academic establishment. Now, consider his 1992 article. It was called "Too Big to Fail, Too Few to Serve, the Potential Risks of Nationwide Banks." Talk about precedent. This is 1992, it's 29 years ago. In 2002, he published an article in the University of Illinois Law Review warning of the dangers that Graham Leach blithely set in motion. And the title is "The Transformation of the US Financial Services Industry, 1975 to 2000, Competition, Consolidation, and Increased Risk." By 2004, Art had expanded his attention to the threat posed by federal preemption to dual banking and consumer protection. And after that time, you were also an important voice in consumer financial protection. Well, it was only after 2008 that Art finally received long due, sometimes grudging, but long due recognition for recognizing the dangers of universal banks. The Financial Crisis Inquiry Commission was shrewd enough to snap up Art for his deep insights and expertise. And we can see how his work on the commission informed his subsequent book, last year's magnum opus, Taming the Megabanks. Now, while Art has garnered overdue respect, he continues to spark controversy. Taming the Megabanks, of course, has his very important proposal to enact a new Glass-Steagall Act, and just to push buttons, another proposal to move all short-term money markets into commercial banks. Art, when the word got out of your retirement, I gotta say there was serious wailing and gnashing of teeth. I don't know how much you were privy to the email traffic, but all sorts of emails went back and forth, mostly lamenting, what will we do without Art? There were some limericks traded, I have to say. I was trying to find some, but I couldn't find them in my email, but they're there someplace. I cannot tell you how delighted we all are that you are as active as ever, just in a new location in South Carolina, and that you continue to provoke and offer your insights. So with that, are you blushing? I can't quite tell, but with that.
A little bit, yes, thank you. I should be, yes.
Okay, let me ask you the first question. If you look back at the very early parts of our careers, you and I were both partners at major corporate law firms. And then we went into academia and somehow we turned into contrarians on banking matters. So my question to you is, were you a contrarian from the start? And how have your views on banking regulation evolved over time?
Well, yes, first of all, Pat, thank you very much for that wonderful and lovely and very generous introduction. And of course, thanks to Erik for putting this all together, and others, all those on this thread, this Zoom thread. I'm obviously deeply touched and honored that all of you would come together and say, very nice things and overlook all my mistakes and failures and shortcomings. But I'm deeply grateful to all of you. And Pat, as you said, we've been wonderful friends. I mean, of course, you have to say how many fellow banking gurus are there? And when you find one who is as passionate about banking as certainly Pat is, boy, I've got someone to talk to who understand what I'm talking about. And I think, Pat, we also shared a common perspective on many things. So certainly our friendship has been a great source of learning and pleasure and sort of intellectual feast for me. And of course, I remember your 2002 article, The Tale of Three Markets, in the Texas Law Review 2002, which I think I remember as sort of the first really big eye-opening piece on predatory subprime lending. And I remember looking at it and saying, wow, I haven't paid enough attention to subprime mortgages. I better start learning more about them. And that certainly helped a great deal when I wrote my article on OCC preemption a couple of years later. I talked about subprime lending a little bit in that 2002 Illinois article, but I was looking at the late 1990s version, and you had picked up on the early 2000s version when Wall Street had gotten into it, and that was, shall we say, eye-opening for everybody. So I think I was a bit of a contrarian. I had an interesting law practice. On the one hand, I was at Jones Day, which is a very fine Midwestern-based national firm. And I did a fair amount of good corporate finance, Wall Street work, particularly during the takeover craze and LBO craze in the 1980s. And I enjoyed that work, but a lot of what I saw on Wall Street didn't impress me. I thought they're chasing after deals. All that matters is, can we close the deal? How many fees can we make? There was very little discussion about, hey, is this a good long-term deal? I mean, are we actually, what is our value added here? On the other hand, I was doing a lot of work for both the Conference of State Bank Supervisors and independent, smaller to mid-sized community banks, not tiny ones, but mid-sized community banks. And they had a totally different attitude toward their business. Their business was relationship-based. It was long-term. Community bankers live in the community. They're going to be there, most of them, their whole careers. Many times it's a family business, but usually it's a career-long business. They see their customers, if not every day, every week, in a variety of locations. And I don't want to idealize community banks, but I found that almost, not all, but almost every community banker I ever met cared deeply about their community, cared deeply about their customers, wanted to make sure that they would serve the long-term interests of those customers. They were very civically involved. And I thought, this is, well, of course, I grew up in a small city of about 15, 20,000. And of course, I saw what community banks did for that city. I also saw what happened when the community banks disappeared from that city. So in many ways, my legal practice kind of, I think, reinforced my own experiences growing up in a small to mid-sized northwestern Pennsylvania city. But I've always valued human relationships, long-term loyalty, care for people. And I found that on the community banking side, and I didn't find it on Wall Street. And so Wall Street always, it always troubled me. And the history I read didn't necessarily lead me to believe that my views were wrong, because I was already starting to read about particularly histories of the 1920s and 30s. I very much appreciated many of the things people have said, but one issue that keeps coming back to me is this idea of the regulatory perimeter and the scope of the safety net, and what justifies the regulatory perimeter and the scope of the safety net. Kristen Johnson mentioned Eugene Corrigan's famous speech article in 1982, which he updated through 2000. And he said, why are banks special? Why would we regulate them so carefully? Why would we provide a safety net for them? And I think his points are worth remembering, because I think they're very relevant today. He said they hold transaction accounts, which in a sense are both savings of households and businesses, and money that they need immediately, they need access to immediately, and money they need to transfer through the payment system. And then he said there are also reservoirs of backup liquidity. We've talked about credit lines and the role they played certainly in a number of crises. It's interesting, in 1987, in 1998, the banks really rushed in with the Fed's help and propped up the securities markets, because they weren't yet so deeply entrenched in the securities markets to be essentially compromised themselves by the stock market crash of 87 and the Russian debt default crisis of 98, although they were getting there in 98, but not yet, irretrievably. But by 2007 and 8, the banks couldn't help anybody. They were so deeply into the securities markets that they were just as compromised as the big five securities firms. The big five securities firms, arguably not Goldman Sachs, but I think they were not far behind. They went first, but the banks were pulled in immediately behind them. I mean, Citigroup was crippled. Bank of America was very badly hurt. Wachovia was crippled. So a number of the big banks that had gone deep into the securities markets were in deep, deep trouble. So they couldn't serve as backup sources of liquidity, because they were no longer protected from the capital markets. And then the last thing he said was they were the transmission belt for monetary policy, because the Fed could really implement monetary policy through the banks, including by setting reserves. Of course, once we disintermediated the banks and allowed things like money market funds and overnight repos and short-term commercial paper to be issued by non-banks, the Fed could no longer really, enforce reserve requirements, and they gradually abandoned them. I must say at this point that, so I think Corrigan's ideas are very relevant today, because we should really care about who has access to deposits. And I think we've seen already the problems when we don't pay attention, that money market funds are just like deposits. We bail them out twice. Repos and commercial paper that are very short term are essentially deposit substitutes. We bail them out twice. Now we're seeing the Fintechs invade into this area. And this is implicating not just the deposit system, but the payment system. So Morgan Ricks and his wonderful work really focused me on this money problem and how deposits are part of the money problem and how non-bank substitutes are part of the money issue. And if we don't control them, we're in big trouble. Now I'm beginning to realize much more than I did before. The payment system is the plumbing. Okay, if deposits are the lifeblood, and I think everybody would agree they are, the short-term, readily available money is the lifeblood of the economy. It's the working capital as opposed to the long-term investment capital. Then the payment system is the plumbing through, or the veins or the arteries through which that lifeblood flows. And now we're neglecting the payment system. We're allowing the payment system to be disintermediated outside banks. So the other day I looked at PayPal. PayPal is holding $35 billion of customer balances in uninsured accounts backed by supposedly some type of reserves. But who's watching? And if PayPal were to, suddenly come apart tomorrow, I'm sure all of PayPal's customers would run to the Fed and say, wait a minute, you guys knew all about us. I mean, at one time, I know PayPal actually found a 2005 letter, comment letter written to the FDIC where PayPal's general counsel said, oh, of course, we keep all customer balances in pass-through deposit insured accounts with our partner banks. We don't hold this money ourselves. Why? How have we allowed that to change, right? So, in other words, we allow the regulatory perimeter to wander, we allow the safety net to wander out from banks that Corrigan talked about to essentially financial conglomerates. Now we're allowing the safety net perimeter to migrate out from the payment system, which has always been understood in its true sense as a banking infrastructure system. Now we're allowing that to migrate out into the fintech universe, and I'm really afraid that we're gonna have to learn the same lesson again. That what you protect, you must regulate. What you don't protect, you can't, and this is Tom Honig's point, you can't intervene to protect something you don't regulate because that just creates moral hazard.
Right. So let me segue from that. You and I have been on various Zoom luncheon workshops over this period, usually organized by David Zering, and David also deserves a big shout out. And I seem to recall in one of these that was fairly recent, a colloquy with an economist, and I think you were the person talking to him. But the question on the table was whether a short-term money market should be moved back into the commercial banking system and restricted to that system. And I was really struck by the economist's reply. He poo-pooed that idea and said, I believe in markets. And the implication was that Art Wilmarth does not. And I would love to hear your response to that comment. I believe in markets for not doing that.
I actually believe in true markets, markets that are allowed to succeed and allowed to fail, that are properly regulated to prevent fraud, that are properly regulated to require disclosure, that are properly regulated to require, to prevent sort of deceitful behavior. But to me, a market that is protected by an explicit or implicit safety net is no market at all. It's maybe you could call it crony capitalism, but it ain't no capitalism that I can recognize. And that's what we've done. We've created a crony capitalism system so that we've now bailed out the non-bank wholesale financial markets twice. And actually more than that, because I think Morgan pointed out, which sort of the last thing I got into my book was to talk about the Fed's rescue of the repo system in September 2019. And it wasn't even clear why the system was failing. Apparently it was because a lot of hedge funds were taking crazy risks in the repo market. But the system froze up and the big dealers said, not our problem, we're not gonna do anything about it. And the Fed rushed in and propped up the repo market. So what happened in September 2019 was simply a dress rehearsal for what happened in March of 2020 on a much bigger scale. The market froze up because of excessive leverage and huge risk taking, and everybody thinking, oh, we can take risk in this market because the Fed has our backs. The big dealer banks said, oh, we can't solve this problem. We're not doing it. We're stepping back, and the Fed rushed in. It's very interesting. The most recent conversation has been by policymakers at the Fed is, oh, we're thinking now about creating a standing repo facility, which will always bail out the repo market whenever there's a problem. And it's like, this isn't a market. This is crony capital. You're distorting, as Tom Honig said, you're distorting every market signal, and people are counting that you're going to keep doing this. My view is we're not going to have a market system on that basis, and we can get into this conversation. But how long do we think we can keep playing the Dutch boy? How many fingers do we have? The dike is getting cracks all around us. The dike is kind of getting higher, and the sea is getting higher, and we somehow think we have enough fingers and toes to keep plugging it. But as Tom said, look at the debt aggregates. The debt aggregate in this country was this is on balance sheet debt, $8 trillion in 2008 or 9, and now it's 30. And if you look abroad, I could find the numbers. The global numbers are even more shocking. The debt aggregates on a worldwide basis are just stunning. It's almost a question of, is the debt market going to crash first in China or somewhere in the West? That's going to be an interesting test of the two systems. But how long can we keep rushing in, bailing out, encouraging more creation of more debt, which the Fed will have to back up, take on its balance sheet when no one else will buy it? At what point do people say, actually, I don't want your treasury bills anymore? And actually, Fed, we don't think that your balance sheet is credible anymore. I'm not saying we're close to that point, but I think we're getting closer than we think. And,
well, we had a scare last March with the Treasury market. So
yes, I think so.
It was very palpable. So let me turn now to your broader proposal for a new Glass-Steagall Act. You and I have been kicking this around for years, and I have to say you were ahead of me on this issue. And one of the themes of our conversation about a new Glass-Steagall Act was my concern when you establish legally mandated structural walls of the opportunity for arbitrage. And back then, my concern was about arbitrage with money equivalents. I think you have addressed that issue quite satisfactorily.
Again,
but
many thanks to Morgan for helping me
many
on that.
thanks to Morgan. Many thanks to Morgan. But of course, there can be other forms of arbitrage. And so one could be overseas activities by US universal banks or large US banks. They'd no longer be universal. Another could be, as Tom Honig pointed out, if the legislation or the implementing regulations are written in a very complicated way, that will be carte blanche for arbitrage. And so let me just say, please address.
Right. So it's interesting. One time I was sort of in favor of what I would call an internal Glass-Steagall approach, because I thought it was more politically feasible that you would turn the bank into a narrow sort of money market type bank, and then you would force the capital market affiliates out, into non-bank affiliates, and then you'd have super strict firewalls, with basically no 23A, 23B, just simply no transfers at all other than dividends up and capital infusions down. And I thought that was Bob Lighton's idea many years ago, back in the 80s, as a way of, for him, it was a way of modernizing banks. For me, it was, well, if you're going to have financial conglomerates, you better, separate the banks from the non-banks. I've sort of given up on that because I think it's not enforceable. I mean, Paul Tucker mentioned that the ring fencing in England, which I think was certainly a good step forward for them because they had never anything like that. But the ring fencing rules as they came out, as far as I've read and understood them, is they basically created a 23A and 23B between their retail banks and the capital markets activities. And that was a big change because they had no such even limited firewalls before. And of course, for reasons we can discuss, and Solly has certainly given us chapter and verse, 23A particularly has not been, very strongly enforced. 23B, we could get into that, has almost not been enforced at all. And then every time there's a crisis, they waive it. So they gave all the exemptions in 2001, 2008, and then as Mark and Jeremy were discussing, in 2020, they gave a new set of exemptions. So my view is firewalls that you take away during the fire, not very good firewalls. If they only work during ordinary times, that's not very successful. Then the other thing, it would be interesting. It would interest you to know that the big banks right now are dead set on getting rid of the ring fencing. There's a review that's been launched by the Johnson government, and they are dead set about getting rid of even these weak, ring fencing rules. So I have felt that the internal Glass-Steagall couldn't be enforced over time. It would be, it would be whittled away to death. Now, external Glass-Steagall, you're right, same problems, except that I think by making an external Glass-Steagall, it would be politically salient. The original Glass-Steagall Act was like 38 or 40 pages long. I mean, I think you have to be longer than that, but you could make a fairly simple, structural, straightforward statute that everyone could understand, would be politically salient, hopefully the public at large would be more willing to, defend it. Also, it would do one more thing, but by breaking the financial industry up into banking, insurance, and securities, you would have these three power centers offsetting each other again, as they used to before the walls broke down. That they really kept each other in check, politically speaking. And one of my proposals is to give every financial provider a private right of action to enforce the Glass-Steagall rule. So if the regulators don't want to enforce it, the private parties could, and take away Chevron deference for any regulatory orders or rules under the Glass-Steagall law, so that they couldn't do what they did the last time, which is, we found this really interesting interpretation of principally engaged, or what a security is, or what underwriting is, and we're calling it something else. And courts, you have to defer to us because Chevron says, unless we're irrational, unless the plaintiff can prove that Congress said no, the court must say yes. Now, to me, Chevron is like turning administrative law on its head, but that's the way it worked. So my view would be no Chevron deference and plenty of private rights of action to try to enforce it. Now that kind of deals with the domestic arena. It doesn't really deal with the overseas arena. I do agree that there would be a lot of pressure. Hey, if we're operating abroad, let us, when in Rome, do what the Romans do. So if Italy says universal banking is fine, let us do it over there. I liked what Simon Johnson said. He said, well, if we have a really good capital system of regulation, I know Simon, like Tom, thinks it should be a lot stronger than it is. But if we have a good system, would we basically say, because there's a weaker system abroad, let's choose the lowest common denominator? I mean, my view is the lowest common denominator is sort of like the road to hell. It's paved with good intentions, but maybe not even good intentions. So we shouldn't go for the lowest common denominator. We would have to say, no, if you can't be a universal bank in the United States, you can't be one abroad either. That would take pretty robust regulation, but I think for the purposes of financial stability, it's worth it. One question we would then have, which we might get into, is, would U.S. banks and U.S. other financial institutions be competitive abroad? That might be a natural follow-up, because it's one thing to say you can't operate as a universal bank abroad legally. Do I believe that you could actually do it competitively, realistically? You want to pick up on that one?
Well, let me ask you this.
Okay.
We've lived through 2010 and Dodd-Frank and did not manage to enact Glass-Steagall, a new Glass-Steagall then. And I find myself quite torn, because I do believe that there are moments I've learned over my career that there are moments when the stars align. But I'm having trouble imagining finding the stars aligning to enact a new Glass-Steagall unless Armageddon happens, which none of us wants.
Right, which, I mean, that's what happened in the Great Depression, right? You needed two things: a Great Depression that was absolutely devastating, and a Ferdinand Pecora who could sort of rip the mask off Wall Street and make it understandable to the public as to what had really happened. You know, we didn't have either of those moments in 2009 and 10 because the government prevented the bailouts, prevented the Second Great Depression. And although the Financial Crisis Inquiry Commission, you know, did some good things, the report is actually, in my view, a very good report. The majority report is a very good report, very well worth reading. It wasn't a Pecora commission. They didn't have a Pecora, and they didn't allow any prosecutor to run it the way Pecora ran the Pecora investigation, so that they couldn't unmask the financial industry in the same way that Pecora did. Now, I think one thing I would encourage people to do is, and I was very pleased to hear, I think Morgan and Kate and other people talk about the 2020 pandemic and how much we should be concerned about what happened during that. I think the story needs to be told. The financial system did not survive during the 2020 pandemic. The financial system was completely bailed out, and the bailout was even more sweeping this time than it was in 2009 and 10, 8, 9, and 10, because now we rescued the bond market. Why do we rescue the bond market? It's because the bond market was horribly over leveraged. There's a recent Moody's report showing that the bonds that have already defaulted in the past year, the recoveries are tiny, pennies in the dollar, much worse than the recoveries on the defaulted bonds in 2010 and 11, because we allowed the corporate bond market to get out of control, again, assuming that it would be protected as it was. So I think we need to tell the story of the 2020 pandemic, just what happened, what caused it, how severe the bailouts and systematic the bailouts were. And then the question becomes, that means that, you know, I think Neil Kashkari said last September, he said, you know, any system that fails twice in 12 years is not a viable system. And he's right. So we need to tell that story. And then we need to talk about, well, how many more times do we think we can do this? In other words, because the next time might be Armageddon. If, for example, the bailouts simply can't be managed, or you have a debt crisis in this country as Europe, you know, barely survived a debt crisis in 2012. You know, the next crisis might be the proverbial straw that broke the camel's back, where even if you attempt the bailouts, as people say, it's not just too big to fail. At what point does the problem become too big to save? When it's too big to save, then it's a Great Depression, no matter what you do. So I would hope that we would, you know, try to shift the conversation toward, we can't let that happen. You know, two crises in 12 years is too much. We can't let a third one happen. You know, we've got to be proactive. But I agree with you. The political forces that would resist would be tremendous. But I think if I would appeal to anyone, let's tell the story. Let's not let Wall Street sort of, which they're already doing. Oh, the financial system worked fine. There was no problem. The system was so resilient. The system was so strong. It's like, are you kidding me? No. That they tried to tell the same stories after 2008, 9, and 10. Oh, the banks really didn't fail. It was just those non-banks. You know, the banks had nothing to do with it. And part of my book is, no, they had a lot to do with it. And in fact, you know, the repeal of Glass-Steagall was at the heart of the crisis because you couldn't have securitized those RMBS, subprime RMBS, and the CDOs and all the instruments that went with it. Without the repeal of Glass-Steagall, first by the regulators, then by Congress, none of that could have happened. The market, the subprime market, could never have grown to where it went. So absolutely, Glass-Steagall was at the heart. The repeal of Glass-Steagall was at the heart. So notice that there are all these stories that come out of any crisis or any major event. And the Wall Street establishment will always try to tell the story, and they have a lot of outlets, you know, a lot of paid advertisers who will tell the story their way. Those of us who feel as we do have to tell the story the other way and say, no, if you look at what really happened, the real facts, let's drill down and look at the real facts. That's not the story. But I agree, it's a huge educational process that has to be done.
You know, one of the things that strikes me about March 2020 is even registering that story with the public consciousness is an uphill battle.
Yes.
It doesn't seem that many people care on the Hill, and certainly the
Right.
general public did not experience that as happening, as even happening.
Particularly professionals, everybody got paid mostly.
Right.
Yes, there were some people who lost jobs, but the professional class generally did, very well. And the stimulus payments. The problem is, bailouts there's a lot to be said for them, but we should admit bailouts are narcotics. They anesthetize people's understanding as to what risks have been taken and what decisions failed. But if you anesthetize a patient, you don't keep injecting the patient with anesthesia after they're supposedly recovered from the surgery. And that's kind of what we've been doing, I'm afraid, in my opinion.
Yeah, I fear that we've gotten the bailouts down to a science, and that's
Yes.
a very, very dangerous place to be. So
Until the Treasury bond loses its credibility, and then
Yes.
suddenly,
there
then the
we
big
have it.
scissors come out and cut the credit card in two. And I pray that we don't get to that point, but we are really tempting the fates, in my opinion.
We are indeed. So Art, with that, I promised Erik that we would keep the trains on schedule, and I think we have. So with that, our session's at an end. And again, just congratulations and thank you, my dear friend.
Yes, thank you, Pat. And thank you, Erik, and everyone else. I really am tremendously grateful to all of you. Thank you.
Save energy, Art, because you're up again at the very end of the conference, and we'll have more chances to roast you. And thank you very much, Pat, for a wonderful conversation with Art and for all that you've done. We have a dynamite panel coming up next. One of the things that Art is involved in so many different levels in our field. He's involved as an academic, he's involved with regulators, he's involved with congressional staff, and he's definitely involved in the policy community. So our next panel is got a number of panelists, including one of Art's former colleagues, but also a number of people from the policy community. And I'm going to turn it over to Graham Steele, who is at the Stanford Graduate School of Business, where he is the director of the Corporations and Society Initiative. Graham has also worked at the Federal Reserve Bank of San Francisco. He was Minority Chief Counsel for the Senate Committee on Banking, Housing, and Urban Affairs, and worked for a long time for our keynote speaker in the morning, Sherrod Brown. So I will turn it over to Graham.
Thanks, Erik. Thanks, Erik, for having me and for putting together this great panel of some of the great thinkers on financial policy, and for putting together the entire event to honor one of the truly great thinkers in banking, law, and policy, who is Art Wilmarth. And I'm just gonna take my moderator's privilege here to do what basically everyone else has done and sing the praises of someone who has been a trailblazer in a whole number of different ways in banking, law, and policy. And as Pat McCoy just highlighted in her intro, is one of the kindest and most generous human beings that you will ever meet, particularly for someone of his immense stature who has been right about so many things over the course of his career. And I think just sort of reinforcing something that Pat said earlier, the title of his book is Taming the Megabanks, but to me, it might as well be I Told You So, because it just sort of puts together his entire career and the way he's been so prescient throughout his entire career about calling out a bunch of the risks in the financial system, and sort of being a Cassandra to regulators and other policy, members of Congress and other policymakers wanting to do things, and Art saying, here's what will be wrought if you do this, and him having been right and them not listening anyway. But hope springs eternal, I guess. And so The title of this panel is Dodd-Frank, What Was Done, What Was Undone, and What Is Still to Be Done. And I think it's a fitting panel here because I'm just gonna quickly try to share my screen. One of the first times I interacted professionally with art was, can everybody see that? Here we go, let's see. Was on a hearing in 2011 about reflecting on the effectiveness of Dodd-Frank's framework for dealing with large, complex banking organizations, what Art calls megabanks. And here it is, and this is a little bit of, I'm sharing this a little bit against my own interest because I am the one that is aged by far the worst out of the three people who are here in this picture, because you all saw Senator Brown this morning, and you've seen Art throughout the program, but this was one of my first interactions with him, sort of reflecting on what did we do with Dodd-Frank, how did it deal with these large complex banking organizations, and will it be effective going forward? And so that's just a little bit of nostalgia from almost a decade ago. And so here we are to reflect on sort of where we are now. And I'll start by introducing our panelists and then do a little bit of intro, and then we'll hopefully have some good back and forth and some exchanges. So, and I'll try to do justice to our august panel who, you know, I could probably go on for 5 minutes on each one of them individually, but all the things that they've accomplished in their career. But I'll start with Professor Lisa Fairfax, who is no less than the Alexander Hamilton Professor of Business Law at George Washington University Law School, my alma mater as well, I will say, and the director of the GW Corporate Law and Governance Initiative. Again, it's gonna be hard to keep her bio down to a brief statement, but I'll say that in addition to being one of the nation's leading scholars on securities and corporate governance, in her spare time, she's also a member of the SEC's Investor Advisory Committee, member of the SEC Historical Society Board of Advisors, a co-director of the Direct Women Board Institute, which promotes board diversity by identifying and supporting qualified women attorneys to serve as board candidates. Next is Andy Green. I'm just going in alphabetical order. Andy Green is a senior advisor for fair and competitive markets at the U.S. Department of Agriculture. Andy has had almost every job there is to have in DC policymaking, particularly in financial policy. He was a senior fellow for economic policy at Center for American Progress, or CAP. Before that, he was a counsel at SEC for Commissioner Kara Stein. When I first met him way back when, he was serving as a counsel for Senator Jeff Merkley, then a member of the U.S. Senate Banking Committee. Then I'll go to Damon Silvers, who is the Director of Policy and Special Counsel for AFL-CIO, where he's worked since 1997. Damon has also had a number of extracurricular activities himself, serving on a pro bono basis as a Special Assistant Attorney General for the state of New York, also as a member of the SEC's Investor Advisory Committee, and from 2008 to 2011, he was the Deputy Chair of the Congressional Oversight Panel for TARP, the Troubled Asset Relief Program, from the 2008 bailouts. And then last but not least is Dr. Marcus Stanley, the Policy Director for Americans for Financial Reform. Similarly, I first met Marcus way back when in Senator Harry Reid's Capitol office when he was working as an economic policy advisor to Senator Barbara Boxer. And Marcus has worked as an economist for the Congressional Joint Economic Committee. He is currently a member of the Commodity Futures Trading Market Risk Advisory Committee. And he, I understand, is leaving the world of financial policy for foreign policy. And so I'm really glad that he can join us to offer what are hopefully his parting thoughts for now, but that he will be back with us at some point in the near future to rejoin the fight on financial policy. So thanks to all of our panelists. And I'll just start with a little bit of a framing and then a question for you all. And hopefully we can sort of keep this live and you all can respond to one another, not have it be too structured. But this is about Dodd-Frank. And when Dodd-Frank passed in 2010, the administration then hailed it as the most comprehensive set of reforms to our financial system since the Great Depression. And very much rhetorically, it was situated in kind of the New Deal tradition of re-regulating the financial system after we had a collapse. But it didn't do a lot of the same sorts of things policy-wise that happened with the New Deal banking laws. That is to say that it did not do structural separation a la Glass-Steagall and the sorts of things that Art is advocating for. A lot of it was about giving regulators discretion and telling them to sort of re-regulate the financial system and do better next time. But one critical exception to that was the Volcker rule, which limited bank holding companies, their affiliates, systemic non-banks from engaging proprietary trading, sponsoring hedge funds, private equity, which again, very much, I think literally was sort of framed as a new and a modern version of the Glass-Steagall Act. But critically, I think it also allowed banks to keep doing certain things that were client-focused, risk reducing. It didn't totally try to unring the bell that happened as a result of Graham Leach-Bliley and financial modernization. So we have on our panel someone who was in the back rooms doing the negotiating and writing that provision. So maybe Andy, you can start for us and just sort of talk about what were you all trying to accomplish with Volcker? You know, what was the thinking there? How did that whole horse trading play out? And to sort of reflect a little bit for us 10 years later, sort of what you've seen and your thoughts on all of that.
Thanks, Graham, and thanks so much also, Erik, for Erik Gerding, Professor Gerding, for this invitation. It's great to be with so many friends on this panel. Let me just say at the outset that I'm here in my personal capacity, not representing the department where I currently work, but rather sharing some historical thoughts from my lived experience and maybe some personal thoughts on a going forward basis. But you know, Graham, you got it exactly right with the intro to your question. And in many ways, Dodd-Frank and the genesis of that legislation leading up to it, a lot of the various thinking was designed to empower regulators to do what they should have been doing in advance and not to fundamentally restructure the organization of the system. I'm not saying that that's a so that was the design of the legislation, but you know, there was a very robust debate as to whether there should be a restructuring of the system. And there we saw during the financial crisis that parts of the system that were failing first were successively acquired by other parts of the system on an ongoing basis, whether it be the hedge fund that collapsed that was then brought back on balance sheet by Bear Stearns. When Bear Stearns collapsed, it was bought up by JP Morgan. You saw that across some of the other non-bank lenders that were countrywide, acquired by, I think it was B of A. It's now more than 10 years ago. But so you had a trend towards consolidation at the time, and you had a trend towards consolidation where the regulators and the political leadership were actually structuring these investments. So there was significant resistance to doing a structural reform of the system immediately subsequent those emergency acquisitions. Because rightly or wrongly, the conversation at the time felt like, well, these private institutions have put their capital at risk to acquire other institutions, and so we can't possibly make them unwind that egg and break them up and do that again. Rightly or wrongly, that's my recollection of the major sort of conversation at the time around structural separation, at least one of the data points. Another data point that I'd like to put on the table for this conversation is that there was a sense that it was, or at least the pervasive conversation was not where Professor Wilmarth has been explaining, and I wish more folks have been listening to him at the time, but the sense was, well, you know, it wasn't that it was the banks, or first of all, it was a conversation the non-banks failed. So the problem is we've got to focus on those non-banks. But even when you started to like push them a little bit, then you got, well, the failure happened everywhere. It wasn't the structural separation that was the problem. It was activities that they were doing. And so you got to change the activities they were doing. Okay, so that's a second data point around the conversation. And then the third data point that I put out there is that the echo of long-term capital management and the failure of that hedge fund was not so far away. And in many ways, when you pushed a little bit on what was going on in 2000, in 2008, 2009, there were echoes coming out of long-term capital management, in the sense that you had it the case that on in the hedge funds and the private equity funds, in the investment banks, and in the banks that were failing. They were failing in part because they were taking large directional risks in the market that were going the wrong way for them. They were not. They were surprised, and they well should have been, perhaps not surprised, but. And so the thought was, well, and this I think is what inspired Paul Volcker's recommendations in the Group of 30 report, that what we need to do is get banks in particular, who are within the safety net, but now post the bailout, a lot of other non-banks were seen as within the safety net because they were systemically significant. We need to get them out of the business of making these directional bets in the markets. And I don't just mean, well, the stock's going up, the stocks are going down. Long-term capital management was a directional bet on volatility. And so in any of these cases, what the desire that spurred the Volcker rule was, hey, let's rein in the risk-taking that is directional. Let's make sure that the key nodes of the financial system are serving clients. And also in doing so, you're reducing the mismatch that undergirds the short-term trading assets and the funding assets that underneath. So Jane DiResta, who's a very well-loved thinker, former staffer to House Banking Committee chairman going way back, wrote extensively about the repo markets and how the short-term repo markets were undergirding the short-term proprietary trading markets. You start reining them back, you start reining proprietary trading back, you're going to rein in repo as well. All of those data points that were out there, in addition to just sort of the challenges of trying to go against the direction that the Treasury Department was setting on this, meant that investing as a political matter in something that turned out to be the Volcker rule was sensible. It was something that my former boss, Senator Merkley, felt was the way we're going to get to a structural separation to the greatest extent possible, in a way that addressed both the things that were going on in the banking sector and in the non-banking sector, and had the most possibility of tapping into the problems that were appearing then and there in 2008 and 2009. And it was a very, very robust fight, and the fight still goes on as things have been dialed back. But I will stop there, and that's a little bit of the flavor of how it emerged where it is. I'm happy to go further into any aspect of that.
That's great. No, that's really helpful. So a mixture of policy, politics, history, a lot of sort of factors coming together in one confluence to determine the way that went. So we've got partial separation and partial activity restrictions, but not going back to the way it was. I want to go back to this idea of better regulation rather than structural reform. I'm going to read a quote and then open up to the rest of the panelists. So in 2010, a former Treasury official said that these enhanced prudential standards, this way of better regulating large banks, would not merely authorize, but require regulators to take stronger actions with respect to constraining risk-taking by the largest firms, because we learned painfully in the last crisis that authority, while necessary, is insufficient. So maybe we could start with Professor Fairfax here and just some of your thoughts on how has that approach held up over the intervening decade, and if there are particular rules that you think are notable successes or failures that you could sort of point to as case studies of, we just need more authority, better regulation, and telling the regulators we really mean it this time. Has it worked? What are your thoughts?
So thank you so much. And I gotta say, you're right. I love my title. And especially because I am on a panel with all of these people who were in the room where it happened, right? So what better? So first, thank you so much to my fellow panelists for all you did and are doing in this space. And of course to Erik for the invitation, and Art for his outstanding book. And I think you are on the one hand right about a bunch of different things. The first is there was, I think, and continues to be at some level, a basic disagreement around the problem, which is why we get these scattershot ideas around the fix. The other is, Dodd-Frank ushered in a bunch of new vocabulary, systemic risk, moral hazard. It wasn't new, but it became like stuff that we now toss around. But I think all shorthand ways of saying all of this stuff is linked. So Andy is talking about, if we remove one thing, that's going to have an impact, right, or on things below the surface in ways that actually we don't know that much about. Because it turns out we haven't been focusing enough on this issue. So that's why, right, Art and Pat, and they talk about the shadow banking, where, all of these innovations that happened that we didn't really have our arms around, right? Turns out there's this thing called securitization that looms much larger than any of us could have ever anticipated. But I will stay in my lane. And by that, I mean, I want to talk about, of course, Dodd-Frank and the fact that Dodd-Frank sought to curtail excessive risk-taking. But I want to talk about that on the governance side, because Dodd-Frank tried to curtail excessive risk-taking in a bunch of different ways. But, I'm sure we all recall the memorable moment that spotlighted the concern around executive compensation when we had company executives, right, come to Congress and beg for bailout money as their companies were tanking, and they had put in place compensation structures that allowed them to reap bonuses and outsize what people viewed as outsized payments. And that really spotlighted a concern and a narrative and fueled this conversation around compensation. Was it a cause? Was it a symptom? Was it an accelerant? Right? The narrative was that it was part of the problem. Right, that problematic pay practices had led to incentivize excessive risk-taking. And so first you saw TARP, and then you saw Dodd-Frank respond to this concern with say on pay, right? An advisory vote on executive compensation arrangement for top executives, right? The idea that these problematic practices either affirmatively incentivized or didn't do enough to curtail excessive risk-taking, and that giving shareholders in particular a voice around this issue would matter, right? So when we talk about what was the regulatory intervention, it was actually shareholders having a voice around curtailing excessive risk-taking, at least as it was connected to compensation. So of course, the first say on pay votes occurred in 2011. So now we have a decade's worth of data, and how are we doing, right? Basic disagreement about how we're doing. Heavily contested. And I think it boils down to really 4 points I want to make around this. 2 that kind of seem like sources of concern, and 2 that seem like areas of optimism. The first source of concern is that actually turns out shareholders overwhelmingly approve compensation packages in overwhelming numbers, right? We get 10 years worth of data, and the average, right, 98% of Russell 3000 companies get approvals every year, and the shareholder approval rate is like 95%, right? Very few failures, ranging from a little bit over 1% to a little bit under 3%. Actually, this year to date, is the highest number of failures, and I'll talk about that in a moment, right? So the concern is actually we can't count on shareholders, right? Those numbers, right? Some people take as they're not playing any role in policing these practices and the associated risks. The second source of concern is that shareholders actually do not seem as attentive to strong economic performers. And what do I mean by that? Several different empirical and academic studies have found that companies are most likely to receive a failed vote if actually they are poorly performing measured by economic factors, right? By short-term share price. And the flip side is that high performers measured by stock price aren't really disciplined. And that's true even when they have problematic pay practices, right? And so researchers say this is a problem on two fronts, right? First, it could actually be incentivizing excessive risk-taking by incentivizing companies to seek to avoid a negative vote by a hyper-focus on short-term profits, right? So now we're back to where we started. And another we're back to where we started is we are not catching those companies that have long-term problems that are being masked by their short-term financial wins, right? And that was one of the lessons of the crisis, that we have these high flyers, and sometimes they're in a group together, a group of high flyers, right? And we don't find out until it's too late that they have problematic practices. And so the research is suggesting that we may not be catching those companies, that in fact shareholders aren't as focused on those companies, and therefore say on pay may not be doing the work we hope. However, two notes of optimism. My third point, which is actually the flip side of what I just mentioned, is that research does suggest that shareholders are attentive to the misalignment between pay and performance, to excessive risk, to poorly performing companies. Right? The primary reasons why you get failed votes are reasons associated with excessive risk-taking, with problematic practices, with the failure to kind of disclose and be transparent around a bunch of different issues. And so while that is especially true with poorly performing companies, it is true that even with other companies, you see these issues emerging with regard to failed votes. So there is some discipline happening. And perhaps more importantly, right, the biggest, I think, win with regard to say on pay and pay practices is that they've clearly changed, right? And you cannot understand the compensation world looking just at failed votes. You have to look at the approvals, and you have to understand that companies, in preparation for the vote, in response to concerns triggered by their packages, in response to negative recommendations, in response to a less than 70% vote, in response to, of course, a failed vote, they respond. They alter their pay practices. And the alterations, right, are to the best extent practicable, aimed at reducing excessive risk-taking, aimed at trying to put in place metrics that shift to performance-based pay, an appropriate mix of fixed versus discretionary, and the focus on the right metrics, and et cetera. And we may not be getting it right. It may not be perfect, but there is a huge change in, at the very least, the oversight of these things and the hoped for rigor with an eye towards preventing risk-taking. And that is happening across the board. So I like to end on a note of optimism to say that, you know, we have, I think, ushered in a structural change as a result of say on pay. That is in fits and starts and may not be perfect, but I think is a notable difference. And I guess the final thing I will say is, because that change was there and the vote was there when the crisis hit. You started to, you know, shareholders, you could tell they were paying attention, because we started to get an uptick in votes when companies started changing their practices in response to, or not changing their practices in response to. And again, maybe they aren't getting it right, but we know at least they're paying attention and they're thinking and looking around, I think, some of the most appropriate metrics.
Great, that was very informative. Enough reason for optimism there that we're not, all hope is not yet lost, I guess. And it'll be interesting to see what comes out of COVID, sort of how these trends move going forward. Marcus, maybe we can turn it over to you. Both reflections on, you know, this balance between structural versus discretionary, and then I want to layer on another question on top of that for maybe you also to think about, which is, the structural remedy of Volcker, the bill's sponsors at the time, after it passed, noted that it did not cover banks' prime brokerage activities. And they said, they called this out, 10 years ago in an article that Andy probably had something to do with in the Harvard Journal legislation about some of the risks of those activities. Sadly, they were not covered. It seems like they have been back in the news, both during COVID with banks' connections to some of the levered hedge funds that caused some disruption in some of the markets. And then with the Archegos episode, more recently, that family office that imploded. So that's two things. One, discretionary versus structural, and then prime brokerage, if you want to work that in as well. We'd love to hear your thoughts on it.
Yeah, well, actually, I think prime brokerage is a great case study in our unwillingness to make structural changes. So I'm actually very glad to make that connection. And I would even think about it slightly differently than structural. I think the Glass-Steagall framework that Art outlined so well in his book, and even reaching back into the Bank of England and its activity during the 19th century, which also had a sort of a similar division in many ways, although not as formalized, was based on what I would call sort of a substantive vision of finance, that different financial institutions were there to do particular things in the real economy and sort of serve particular financing needs, whether that's working capital for business or hedging for farmers and agricultural industries, or raising new capital for business. These are sort of substantive needs, and you sort of qualitatively tailor each financial institution so it sort of serves that substantive need. And going along with that is a distinction between sort of substantive finance and speculation, which is seen as less legitimate. And in the sort of efficient markets model, that distinction actually doesn't really make a lot of sense. From the economist's perspective, markets sort of are our substantive guide in some sense. Markets are efficient and they are intelligent and they are steering resources to their best purposes. And therefore we have to keep markets going, and speculation is a critical part of markets. And in fact, in financial markets themselves are inherently speculative because they're sort of placing bets on the future, which is inherently unknowable. So we move away in the Glass-Steagall framework. It was kind of like, well, we have banks that are financing businesses, and we have other kinds of banks that are providing mortgage financing, and we have commodity markets that are for hedging, and we can sort of regulate them qualitatively along the lines of what it is they're supposed to do. And we can see that within the multiplication of different regulators within the US financial system really comes out of that. But then as we move away from that over the 60s, 70s, and then especially the 80s and 90s, we become sort of, we sort of allow all these markets to merge and capital to flow freely between them. And it becomes seen as interference with markets to guide them to their substantive purposes. And instead, we have to manage their risks. So we kind of conceive of ourselves as a hedge fund or someone on a hedge fund or trading desk who's managing their risk, with risk taken as some, kind of aggregate quantitative metric. And then our extra mandate as the regulators of the system is that we have to stop something called systemic risk, which is risk that destroys liquidity in the system. So there's a liquidity breakdown, and actually all institutional risk management becomes impossible for the individual entities because they can't sell anything at any price. So we have to stop this systemic risk thing. And it's just a totally different framework than Glass-Steagall. And it actually has many more continuities with the pre-financial crisis mechanism than it has differences, because you look at the core mechanisms that are used, risk-based capital, stress tests. These are all things that started in the 1980s with Basel, and it's just kind of like, well, we're going to really do it this time. And we're going to politically give people more backbone to actually make the banks hold more capital this time. And, Art, it was one of the few points in the book where Art went easy on contemporary financial regulators, because he actually overestimated, I think, the changes in Dodd-Frank, because he said it created a new super regulator, systemic risk super regulator called the FSOC. Well, the FSOC isn't a regulator at all, let alone a super regulator. It has no direct regulatory powers. It's just has the power to hand things over to the Fed. And it's sort of a expanded version of the president's working group on financial markets. So we didn't even really get a new regulator. But what we did get is we got the regulators said, well, it can happen here. It can happen. We could have a Great Depression. So they did sort of have the guts to require the banks to hold more capital than they previously did. That much did happen, but there are really a lot of limits to the extent that they can do that, because you can't force banks on a risk management model to provision out to the extreme ends of the risk distribution. There's a great, in Robert Rubin's autobiography, there's a great thing where after Basel, Goldman decides to do a stress test, and they all get together and they all say, do this test. And then he says, well, we concluded that if we really wanted to take into account a real catastrophic contingency, we couldn't be in business. And that's still what happens behind the scenes with these risk models. Is it's just kind of like everybody knows there's only so far that you can push it. And then with Volcker, I'm not going to go into much detail on that, but Volcker is different. It's the thing that stands out as different, that challenged the regulators and told them, really, we want you to define a business model for the banks that's substantive, that serves social benefit, which is, and then cut off speculation from that and actually restrict them from speculation. And frankly, the regulators spit out Volcker like a hairball, like a cat spits out a hairball. There was this endless fighting about, can we even do this? Is speculation necessary for these guys to provide liquidity into the markets? And they hemmed and hawed and came up with this insanely complicated mechanism, which at least, did a little, but told the banks to measure their speculative exposures at least, and then said, well, later, after they measure it, we'll figure out how to restrict it. And then more recently, we've come back and they said, well, let's throw out half the bank's assets from even that measurement framework, and let's weaken the measurement framework. And oh yeah, we won't let them do hedge funds with stocks, but we'll let them do hedge funds with corporate bonds now and corporate credit, as though that's not the riskiest market to go on now. And I don't really see a lot of momentum to reverse that. And the regulators were not eager to take on that challenge of restoring a substantive regulatory model in the financial markets, and rejected it. So, and prime brokerage, I think, really comes in here, because prime brokerage is an issue that goes back. Art writes about how in the 1920s, Carter Glass was like, we don't want the Federal Reserve financing bank loans to speculators in the financial markets. Exactly the same issue. And prime brokerage is the mechanism by which banks provide liquidity support for speculation in the financial markets. And, some speculation may be necessary, or, probably is necessary, but the idea, what is the social utility of hedge funds being able to place any bet they want with unlimited leverage? What is the utility of them trying to earn 10 basis points and leverage it up to 10%, of having no leverage cap on that. Not only is the social utility extremely mysterious, besides making more money for rich people, but we know for certain that it adds to the fragility of the money markets and the fragility of the whole financial system, which is potentially disastrous. So if we were thinking at all about, outside of this like risk management model to what is the substantive point of stuff that we're doing, we already would have put very sharp limits on prime brokerage. And post March 2020, we really need to, because fundamentally, when you refuse to make this distinction between substantive versus speculative activity, you're stuck bailing out everything, because the substantive and speculative plumbing get interwoven, and you're always afraid the substantive stuff is going to collapse. And so whenever anything bad happens, you're like, let me shower you all with money, and you end up bailing out the speculative hedge funds as we did in March 2020. And you create huge pressures for asset inflation in the system that are, I think, acting out now and having a real impact on the economy. So that's my little speechlet there.
Hey, great. Thanks. A lot for us to think about, a lot on the table now. Damon, maybe you can hit cleanup for us here, bring it all home. Andy mentioned the focus back in 2008 to 2010 on non-banks, the risks they pose. I think a really important part of Art's work is not just letting banks do whatever else anybody else is doing, but also letting anybody else do something that is effectively maturity transformation as we think about the banking business model. And a really salient example of that is money market mutual funds. Big role in 2008, back in the soup again at the beginning of COVID with the public fisc standing behind it. We know the SEC went through a process in fits and starts to try to reform it in the intervening decade, and we saw how well that went. So if you want to bring money market fund reform into this and tell us what you think about the SEC as a regulator of bank-like activities, or also just opine on Volcker or Say on Pay or any of the stuff that we have here already, the floor is yours.
Well, thank you, Graham. And it's a pleasure to be with this very distinguished group of people. Some of my favorite people in all the work I've done in my career are on this panel. And so it's just a nice group to be with. And not surprisingly, here to honor, I think, all of our friend and teacher, Art Wilmarth. I'm not sure. I never took a class with Art. I don't know if my other panelists have, but I know we all learned from him and I think not just learned from him, but it's hard to remember this clearly now. But if you think about the environment that existed as the financial crisis built in 2007 and 2008, and all the kinds of the power of a variety of forms of conventional wisdom that were out there at that time. As Graham, you pointed out, some of us were younger then, and it took a certain amount of courage to challenge some of these things at the time, and having Art's scholarship and Art's personal presence during those years, I think was very important in the evolution of what happened, and in the ability of the people on this panel to do the work that we all did during that time. And so I just want to, Graham, I want to first just take that moment to recognize Art's role as not just a scholar, but as a confidence builder for those who were paying attention to what he was saying. Let me, I'm going to come at your question about the SEC and money markets and so forth from a kind of weird angle, but you'll see that I have something to say about it. I think, again, to think back to the beginning of the financial crisis and to understand what happened then and how that has shaped the world we are in now. All right, I want to begin with a couple of stories. I think that was my task here. I was supposed to tell stories. So I'm going to start with a story that I wasn't there for, but someone who was there told me about. And it was about what happened when Drexel Burnham failed. And I don't know if a lot of people listening to this probably don't know who can't vaguely remember who Drexel Burnham was, but Drexel Burnham were the people who invented the junk bond, basically. I mean, or turned it into a big business. And they were, the high flying firms in the 1980s. The movie Wall Street is essentially about Drexel Burnham, and Drexel Burnham failed, and somebody important at Drexel Burnham called up the Bush administration, the Treasury Department, and said, "We're going down. You have to rescue us." And the Treasury Secretary took the call, and it was Nick. And I forgot, I'm blanking on his last name, but the Treasury Secretary took the call, and he turned to his deputy, and he said, "Isn't Drexel a stock brokerage?" And the deputy says, "Yes, Mr. Secretary, the Drexel Burnham is a stock brokerage." And the Treasury Secretary hung up the phone. He said, "We don't," and he turned to his deputy, he says, "We don't bail out stock brokerages." And he hung up the phone. And by contrast, today, as we sit here, at least according to published reports, the financial firm, and I'm not quite sure what you call this firm. I gather it technically is referred to, people refer to it as a hedge fund, but when I tell you what I'm about to tell you, you'll wonder, like, what is it? The firm Citadel, it was revealed during the GameStop farce. During the GameStop farce, it was revealed that, at least to the public, I think other people may have known this, it was revealed that the firm Citadel controls 38%, in the sense that 38% of equity trades touch Citadel. Now, Citadel is not regulated, as far as I know, as a systemically significant institution by the FSOC, which back when it was alive. Now, I believe Secretary Yellen is doing her best to revive it. The Trump administration tried to strangle it. Citadel's not a systemically significant institution, yet
leaving us on the edge of our seat.
It would take an act of significant courage to have failed. It would take an act of significant courage on the part of the Treasury Secretary to hang up the phone. Right? Now, that is where we are today. Right? That's not an abstract proposition. It's a factual description of the equities markets today. And the SEC, Citadel doesn't fit easily into any of the buckets at the SEC. And the actual existing structure of the equities markets significantly challenges the SEC today. And it is not in isolation from the credit markets, which is what several of you were talking about. Right? The GameStop episode and the discontinuities that occurred in the short-term credit markets and the short-term treasury markets last year, which are profoundly connected with the banking system, these things are all connected. And Dodd-Frank, while Dodd-Frank did many good things, Dodd-Frank did not create the tool set for dealing with this. And in significant ways, developments in the equities markets that were ignored during the time that Dodd-Frank was being put together, and that had been essentially encouraged by the SEC back before the financial crisis, have now merged with the unaddressed problems of Dodd-Frank. By which the unaddressed problems are where, I think, Graham, where you started us today. The unaddressed problem is the failure of Dodd-Frank to make a clear policy choice to make structural change in the financial markets. So Dodd-Frank left it undecided whether we were just going to do what Tim Geithner wanted and Larry Summers wanted, which was enhanced oversight, clear line of sight. By the way, Hank Paulson was all for that too. Right? In fact, I think he was for it in certain ways, in more sincere ways after his experience in 2008 than Tim was. There was this question that this panel has been talking about in every angle. There was this question of, are we going to simply give the regulators more line of sight or are we going to change the structures of the market? The Volcker rule was the gesture in the direction of changing the structures of the market. But the truth was that all of the answers to those questions was left to the regulators. And that the regulators either failed to make a choice or chose supervision rather than structural change at every turn. And so, for example, there's pieces of Dodd-Frank's regulatory structure that are undone. The regulations don't exist. And
are we going to get him back?
Wall Street zapped him.
They don't want to hear about it. They're dumb. They don't want to hear it. Well, you back?
No, I can hear you. Can you hear me, Graham?
You're back now. You were frozen
Okay.
for a minute. Yeah.
Okay. So I don't know if you heard this, but we're talking about the executive pay rule. Executive pay rule is unfinished, never been enacted.
956.
That question was left hanging by Congress and answered the wrong way by regulators. It was deeply connected with and it sort of became the question, which grew and grew and grew in importance in the context of quantitative easing, of to what degree is it the job of regulators to, in any respect, take a view on where capital should be flowing in the financial markets. Right? The New Deal answered that question with a resounding yes. The entire New Deal financial structure was about the active structuring and channeling of capital. But it wasn't about getting rid of markets. It was about, as Mariana Mazzucato at the University of London would say, the creation of markets and the definition of markets. The failure to do that, the failure to understand that it is the role of democratic government with a small d to do that, right, has, in my view, driven our democracy to the edge of illegitimacy. Right? That it is the underlying dynamic that brought us to January 6th. Right? And the responsibility for having got there lies with those who made the choice not to hang up the phone when that kind of call came in, or else to say, oh, when the call that Citigroup was going